Hello, my name is Adam, and I'm going to teach you how to trade options on WeBull today. Now, you might look at the length of this video and go, wow, that is really, really long. Do I actually need to know all of this? And the answer to that question is yes. You must have a general understanding of everything we're going to discuss today if you want to have any hope of having a modicum of success trading options. This stuff is foundational. It is absolutely critical for you to have any success. And it might seem like a lot at first. But as we go through it, you'll start to realize that things are clicking, things are starting to make more sense. And as you go back and study each section of this video, it'll become more and more second nature to the point where it will be easy and you'll be able to go on and learn more sophisticated strategies aside from just buying puts and calls, which we're going to discuss today, and be successful at it. So don't panic. It might seem like a lot at first, but listen, I'm not an absolute genius and I got it. You can do it too. Now, if you have not signed up for WeBull yet, but you're about to, please use my link in the description below. Okay, if you use that link, deposit $100, you'll get 2 free stocks. Okay, it helps out the channel, helps out you. It's a win-win. In addition to this, if you notice I say something that sounds off or not quite right, check the pinned comment before you come commenting to me and saying, Adam, you big donut, you goofed. If I make a mistake, I will find out eventually and I will put it in the pinned comment. So check there if you feel like something isn't quite right. Also, you may have noticed already that this video is broken down into sections. If you have your cursor over the buffer bar, that'll allow you to skip to certain sections you're interested in or go back and study certain sections. And it's also worth noting that at the end of each section, I'm going to ask you some questions and you can kind of answer those questions in your head. And those questions are just there to make sure that you're keeping up with the important topics of each section. And if you want to check and make sure that you're getting the answers to those questions correct, you can look in the description. You'll find all the answers typed out down there. So we're going to be using the mobile app in general as the reference today, although everything will also apply to the desktop or a web version of their platform. Now, before we really dive in and start learning about options, what they are, how they work, how to trade them on WeBull, the first thing we have to do is apply for options trading. To do this, open up the app, select the account you're interested in, go to More, and then Option Trading Level. Here you can apply for options trading, and there are 3 different levels for options trading. As you go up each level, it'll unlock access to more complicated strategies. Yes, you can buy puts and calls, which you may have already heard of already, and we're going to discuss that a lot today. But you can also combine puts and calls in different unique ways to make certain payouts depending on where the stock goes. It can get very interesting, but also a little bit sophisticated. But I recommend you go for level 3 if possible, because it'll allow you access to all option strategies, and you are going to go out there after this video and learn more sophisticated option strategies, because there's a lot of unique ways that you can combine these options together that'll really fit your goals. For a quick example, there's something called a cash secured put, where you lock in a certain stock price to buy shares at, and for doing so you get some money. Sounds pretty sweet, right? You lock in a price to buy shares out, you get some money on top of it. So instead of just buying shares outright, you can lock in that price and get some money for doing so. So there's unique ways that you can trade options that you wouldn't be able to have access to if you just got level 1 options trading. Okay, so unlock level 3 if possible so that you can go out there and learn everything and use everything. But if you only get level 1 for whatever reason, that'll be good enough for today, because we're generally going to be talking about just buying puts and buying calls, because that's the basics. That's the foundation of options. All right, and the second thing we have to do before we get going is make sure our options data is up to date. To do this, go back to your account, hit Quick Trade, tap on any stock. It doesn't matter what it is. You can look up Google if you want. In the bottom right, tap on Options. And at the top, you see that little blue clock there. If you tap on that guy and then tap on Oprah Real-Time Data, that hyperlink, it'll take you to a page where you can subscribe to options data for $2.99 a month. If you don't do this, you won't be able to really trade options, because your options prices are going to be delayed by 15 minutes. You're going to be lagging behind everybody else. You can be just guessing what the current price is. So you have to do this in order to trade options. All right. Now all that housekeeping is out of the way, let's learn how to trade options on WeBull. All right. So what we're looking at here on the right side is called an options chain. Okay. And we're going to use it to explain call options. So if you want to follow along, open up WeBull on your phone, go to Quick Trade, about 2/3 of the way down the left side of your screen there. If you want to follow along exactly, you can look up the same stock I'm going to do this on, which is AMD. And then in the bottom right, tap Options. Okay, so the numbers are going to be very different because it's different day, different price data and information, but the same layout. So it'll be more than enough to really dig deep into what call options are, how they work. Call options are these contracts that you can buy. And the reason someone would buy a call option, for example, would be to make money as a stock goes up. People might buy call options as compared to just buying the stock outright because they can put up less cash but get the same or more leverage than shares. So for example, I might have enough money to buy one AMD share. If I buy one AMD share and AMD goes up by $1, well, guess what? I make $1. But if I take that same amount of money and put it into AMD options and AMD goes up $1, I can make more than $1. So for the same buying power, a call option could give you more leverage and you can make more money if the stock price rises. Now, there's a lot more to it than that. It's not as simple as just having leverage, but that's a general reason why someone would buy a call option or buy a put option. What we're looking at here is a list of different call options. There's a call option here, there's a call option here, here. So all of this information pertains to one call option. All of this information pertains to one call option. All the way up and all the way down, you can scroll up and down. There's tons of different call options, and we'll get to expiration dates, but there's different call options with different expiration dates. You can see those down here. There's a lot of different call options to choose from. And we are just going to talk about call options for now, and later we'll discuss the difference between put options and call options. Call options, you're betting on the stock going up. Put options, you're betting on the stock going down, but there's a lot of overlapping similarities, and it'd be very repetitive to go through both calls and puts at the same time. We'll just discuss the differences later. So on the right side, there's put options, but we just want to ignore that for now. We're just going to talk about call options. Okay, so keep your eyes on the left side of the screen here. Okay, so we see call options, but you probably can't even like interpret the numbers you see before you. We don't have any context. So let's get some context. Let's define what a call option is. A call option is simply a contract between a buyer and a seller. It's an agreement between two people, two parties, you and your counterparty. In all of the examples today, we are going to be the buyer of these options. It is possible to be the seller where you actually create the contract and sell it to somebody, but that's a little bit more sophisticated and comes after learning about buying calls and puts. And generally speaking, when you first start trading options, you will just be buying calls and puts, and that's how you'll get your first taste of options and what they're capable of. So we're going to be the buyer in all these examples. So a call option is a contract between a buyer and a seller. So between us and a seller. This call option gives us as the buyer the right to do something. It gives us the right but not the obligation, which means in simpler terms, you can but you don't have to. The right but not the obligation, you can but you don't have to buy 100 shares of an underlying stock at a strike price. And that is a big mouthful, but let me break it down here. So a call option allows you to buy 100 shares. It allows you to buy 100 shares of what? An underlying. AMD is our underlying for these options. In other words, AMD and all of these call options we see here are interlinked. They're connected together magically. When AMD's stock price moves, it's going to affect the value of these call options. So because call options, as we've mentioned briefly, allow you to bet on the stock price going up, well, because AMD and these options are connected, when AMD's stock price rises, everything else held constant, these options will increase in value. So if you own one of these, just like if you own a share, if it increases in value, you could sell it for more money than you bought it for, you can collect a profit. So these options and AMD are interlinked. So that makes AMD these options underlying. AMD is the underlying because it is what the options are traded on. It is what affects these options prices. So if I say the underlying increases by 20%, well, if we're looking at these options, you know that I'm talking about AMD. So AMD is the options underlying. So we can buy 100 shares of AMD if we have a call option, one of these call options, and we buy them at a strike price. You can see the strike price right here, right down the middle. And for some reason, it increases as we go down, which is really annoying. You could probably change it in the settings right here, but I wanted to keep it the same screen you get by default, so there's no confusion. So these are the strike prices. So let's say we own one of these call options, and we'll get into how you get one of these call options in your possession here in a little bit. But let's say we own this call option. Well, let's look at its strike price. Its strike price is 95. So if I own this call option, it gives me the right to buy 100 shares of the underlying stock, which is AMD, at the strike price of $95 per share. So I could buy 100 shares of AMD at $95 per share. And this process of buying 100 shares at $95 is called, or the strike price, is called exercising your call option. On every brokerage out there, if they allow you to trade options, there is a button somewhere that says exercise, and you can tap it, and this will automatically happen. You will buy 100 shares at the strike price. Now I want to pause for a second and say, yes, you can exercise a call option. The ability to exercise is what's going to drive the value of these options. And we're going to discuss this in great depth. But it's important to understand that even though you can exercise call options, and that's what drives the value behind call options, the vast majority of cases and the vast majority of scenarios, it is not cost effective to exercise. In fact, most of the time, if you do exercise, you'll lose money. And we'll discuss that down the road here once we start putting more building blocks together. But for now, just know, without knowing the reason behind it, that you generally speaking will not exercise your call options. The reason we're going to discuss exercising and what it means and how it affects different options is because you have to understand what exercising is in good detail before you can understand where the value and prices of options come from and how they fluctuate. So for right now, don't get confused. We're going to talk about exercising and making and losing money through exercising, but you will almost never exercise. It's pretty rare. There are very few scenarios in which you will. Okay, so let's say we do have this call option in our possession and we exercise it. What happens? We buy 100 shares at the strike price of $95. That's good for this option because if we buy 100 shares at $95, we can go right back and look at the current market price. These shares are going for $96.84. If I buy 100 at 95, I could sell 100 at 96.84, collecting $1.84 per share of those 100 shares. So if I collect $1.84 per share of those 100 shares, I extract $184 of value through exercising. And that's the case for any option whose strike price is less than the current trading price. You would be able to exercise and extract some value. Now, this value is not necessarily profit. Like I said, we'll discuss that in a little bit. You might actually lose money, but you can extract some value out of exercising if the strike price is lower than the current trading price. So that means that you could extract value for any of these options. And we call these options where you can exercise and extract value in the money options, in the money. And you will see that abbreviated as ITM. Well, how about, let's say, I'm not saying it's necessarily possible, but let's say that the strike price of an option that we own is $96.84. Well, if we exercise, we buy 100 shares at $96.84. And then if we go back and sell them to the market, we sell each one of those for $96.84. We haven't extracted any value. We haven't lost any value. There's no difference between, buying 100 shares at the current market value versus exercising that call option. And we call those options where if you exercise, you don't extract any value, but you also don't lose any value. We call those at the money options. So if the strike price is equal to the current trading price, that option is going to be called at the money. How about if the strike price is greater than the current trading price? Remember, we're going down. Okay, it's confusing because you'd think that it'd be lower, the strike prices would be lower, but they're actually greater than the current trading price, so don't get confused. Well, let's say we own this option right here. If we buy 100 shares at 97 and then sell at 96.84, we're losing 16 cents per share. We'd actually be losing value through exercising these options. And any option you exercise and you lose value, in other words, any option whose strike price is greater than the current trading price, is known as out of the money. So all of these are out of the money, OTM, out of the money options, where if you exercise, you would actually lose value. And each type of option is going to have very unique characteristics, and we'll really delve into those in future sections. But you do just need to know what these options are called in the money, at the money, and out of the money, and why they are called that. What is necessary for them to be called that? So for example, for out of the money, if the strike price is greater than the current trading price, then it's out of the money, and you need to know that. Okay, how do I get one of these options in my possession? We've talked a lot about exercising. How do you even get one into your possession in the first place? Well, you do so just by buying it. Remember, this contract is between a buyer and a seller, and we are the buyer in this scenario. We have to buy this contract from a seller if we want it. So let's look again at this 95 strike call. Well, this call has a certain price tag associated with it, and it's not the strike price. Don't get confused by that. That's not what you pay to get this option in your possession. The price is actually right here. You can see that it says last at the top. That means that's the last traded price. That's the last price that a buyer and a seller met and exchanged the contract for. So the buyer paid that much to a seller to have the contract, to have the right to exercise it. This number right here, this $2, and this is $2.01. A lot of times you'll see a dollar sign associated with it. It's $2.01, and that's how much we paid to get this option in our possession. But this $2.01 is not the entire amount you pay for this option. So let's write it right here, $2.01. We don't pay that much for that option. We pay more than that, in fact. $2.01 is how much we pay $2.01 is how much we pay per share of the 100 shares that the contract controls. So this is a premium we are paying for the right to exercise for each share that we can exercise for. And remember, we can exercise for 100 shares. We can buy 100 shares of the strike price. So we pay $2.01 to have that right to exercise for each share of those 100 shares. So we have to multiply this by 100 because you cannot exercise for anything more than 100 or less than 100 for one call option. It is fixed at 100. Well, then we are paying $201 for this call option. So I will demonstrate to you later how you actually enter an order to buy a call option like this, but this is the amount we're paying to get this call option into our portfolio where we can actually see it on our screen and see that we own this call option. We pay $201. So when you look at these prices and on different brokerages, maybe even on the desktop platform, they'll have a dollar sign. When you look at these prices, remember that they are multiplied by 100 in order to get the more realistic amount you'll pay to get this option in your possession. So let's say we do that. We pay $201 to some seller and we get this 95 call into our portfolio. Well, after we've paid $201, which is called paying a debit, any money going out of your account is a debit, any money coming into your account is a credit. Once we paid that money, the value of this contract will not stay fixed. The value of this contract moves around, and you can kind of see how much it moves around by. So if I buy it right here, well, what happens if it gets more in the money? Let's say it gets $1 more in the money. Let's say this jumps up to $97. Well, let's look at the dollar. Let's look at the call option that's $1 more in the money. You can see it's worth $2.89. If it becomes even $1 further in the money, it becomes worth $3.75. So the deeper in the money an option is, a call option gets, the more valuable it gets. So in other words, as the underlying stock, AMD, rises in value, so does the value of your call option. So let's say we buy this option and we pay a debit of 201. Okay, we're going to write it in premiums terms. Okay, that's generally how you'll see it written. This is a debit. Debit meaning the money goes out of your account. You no longer have it, but you do now have this 95 strike call in your possession. Well, let's say that the stock price does rise to 97 and it becomes $1 more in the money. Well, it might be worth 289 because this call option right now is $1 more in the money. So it's a good representation of what would happen to our 95 strike call if the stock price rises by $1. So it might be worth 289, and we can go and sell that contract back to the market, back to somebody else for 289. So again, all that's happened is we bought this call option, this 95 call, and we're simulating that the stock price rises, the underlying rises by $1, pushing this call option $1 more in the money. And to simulate that, we look at the call option that is $1 more in the money. It's worth 289. So if it's worth 289 now, we can sell it, which would give us a credit, meaning money is coming in the door. And we can take a look at what our profit is. If we bought for 201 but sold for 289, we made a profit of 88 cents. Remember, this is all in premiums terms, is what I like to call it. When you look at this, it's called premium. These numbers right here, $1.24 is a premium of this option. It's how the premium you pay to own this option. I call this premiums terms. So if you see 201, this is in premiums terms. It's per share of the 100 shares that the contract controls. So if we want a more realistic number, we have to multiply it by 100. So our profit here would be $88. And this is exactly how you trade call options. You buy a call option. You hope the stock price rises, and so the value of your call option rises, and then you sell it for more than you initially bought it for. And now you're no longer in the trade. You have no counterparty anymore. Okay, the counterparty is now the seller and the new buyer who bought from you, and you're out of the trade. You made some money. Bada bing, bada boom, that's it. Now, the exact opposite could happen. Let's say, instead of this rising to $97, let's say it dropped to 95. Well, the value of our option might go from 201 to 124, and we lose $75, $77 on the trade. Okay, so you can lose or make money. If the underlying goes up, you make money. If it goes down, you lose money. This is a lot for one section, so take your time. There's a lot more coming, so just wrap your head around this idea that there are options where you could exercise them for certain amounts of value, and the amount you can exercise will play into why these increase and decrease the premium, why it increases the further in the money it gets, or why it decreases the less in the money or the further out of the money it gets. You can see it goes all the way down to 7 cents per share of the 100 shares that contract controls. So what you can exercise it for will play into this premium, and we'll discuss that later. But what I want you to really understand right now is the definitions of out of the money, at the money, and in the money. I want you to understand that as the underlying rises, a call option will rise in value as well. I want you to understand the reason people trade or buy call options, individual call options, as compared to owning the underlying stock, is because it provides leverage. I want you to understand that it's no different than really buying and selling shares in the sense that you buy at a low price, hope the value of the call option rises so that you can sell for a higher price and sell for a profit. And that is generally how people will trade options when they're just trading single options, when they're buying and selling. There's more complicated strategies where you paste these together and it has weird payouts and all that. But for now, when you're just buying call options, you try to buy at a lower price, hope the value rises, and sell for a higher price. Now, if things go down really, really low, the max you can lose is whatever you put into the trade. So if I bought this call option for $201 and the stock dropped all the way to zero, I'm going to lose all the money I put into this trade. I'm going to lose all $201, but that is it. I can't lose more than that. That's one of the nice things about options is that they are a defined risk strategy. You can't lose any more than you put into the trade. All right, so the questions for this section to make sure that you're keeping up with the important ideas are the following. What does a call option give you the right to do as the call option owner, as the buyer of that call option? What is premium? What does that mean? Why is it important? Define in the money, at the money, and out of the money. What does it mean if a call option is in the money? What does it mean if a call option is at the money? How about out of the money? Define underlying. If I'm trading options on an underlying, what does that mean? What is an underlying? And generally speaking, should you exercise options? Yes or no? Now, you don't have all the information in your brain yet to fully understand why the answer to this question is the way it is, but we'll get to that. At this point, though, you should know whether or not, generally speaking, you exercise options. You just may not know exactly why yet. So pause, answer those questions, make sure you have a good understanding, and then move on to the next section. Let's do it. In the previous section, I briefly mentioned that the ability to exercise is what drives the value of options. It generates the prices of options, and it explains why options prices change. However, I haven't exactly explained the exact relationship between the ability to exercise and premium. And that is the purpose of this section, is to explain why options are priced the way they are and why options prices change and how. So I've left in the money, out the money, and out of the money here because I think it's pretty counterintuitive how the strike prices increase as you go down. So I'm just leaving that there so you don't forget which ones are in the money and out of the money. Okay, let's look at an options premium and break it down. So let's look at the 95 strike call. We're gonna look at the $2.01 of premium. We're gonna ignore this $2.05 and this $1.98. Those are the ask and bid prices, and we'll discuss that later. Right now, we just wanna look at the last traded price. Let's write that here, $2.01. There are two things that explain why this option is priced at $2.01. The first is that this option can be exercised for some value. As we mentioned before, any in-the-money option can be exercised for some value. Because the strike price is lower than the current trading price, strike price being 95, current trading price being 96.84, we can exercise this option, buying 100 shares at 95, and then sell 100 shares at 96.84, collecting $1.84 per share. So this option and any in-the-money option can be exercised and you can extract some value by doing so. And like I said, we can extract $1.84 per share. So let's write that here. Overall, we would extract $184 because we're doing that for 100 shares. $1.84 per share for 100 shares is $184. So $1.84 is built into this options premium based on whatever you could exercise it for. And this portion of the premium is called intrinsic value. Intrinsic value is the portion of the premium given to the option based on whatever you could exercise it for. And following that logic, because out-of-the-money options cannot be exercised for any value, out-of-the-money options have no intrinsic value. Out-of-the-money have no IV, intrinsic value. Well, this doesn't necessarily explain all of the premium because, well, number one, out-of-the-money options are priced, okay, they have prices, but they have no intrinsic value, so they must be priced for some reason. And this also doesn't explain all of the $2.01 of premium. We've only explained $1.84 away. So what's left over? Well, we have 17 cents left over that we have yet to explain. And this 17 cents is called extrinsic value. Extrinsic value is the portion of the premium given to an option based on days till expiration, and something called implied volatility, which I'm going to shorten down to imp vol here. So I haven't mentioned it yet, so I'll mention it now. Seems like a good time to do it. Options have expiration dates. All of these call options we're looking at here expire on the 18th of December 2020. You can tap on these expirations down here and see an entirely new options chain. We have expirations for the 31st of December 2020, January 2021. You can go out years. There's tons of expiration dates and tons of different call options. So options have a lifespan. There's a certain amount of time for them to get in the money or get deeper in the money to build up intrinsic value. Not necessarily that they to exercise it, but because they could be exercised. So they will gain intrinsic value as they get in the money or deeper in the money. So options have value given to them based on how much time there is until expiration, because the more time you have for the option to get deeper in the money, which means that it'd build up more intrinsic value, it'd be worth more. So because more time means more time for it to get deeper in the money, it also means more extrinsic value. There's some value given to the premium based on the fact that the more time you have for it to get deeper in the money. And you'll see this if you tap on expiration dates that are further out in the future, the options will be worth more, even if they have the same strike price. If they have the same strike price, if they have the 95 strike price, they will have the same intrinsic value as our option here, but their extrinsic value will be higher. It'll be greater, making the overall value of the option more expensive because there's more time till expiration. There's more time for it to get deeper in the money to start building up even more intrinsic value. So as you tap on options on expirations that are further out in the future, you'll see that the options are more expensive. And that's part of the benefit of buying options that are further out in expiration, is because they have more time to build up this nice thick layer of intrinsic value to start accruing more and more value, such that if you buy now and it builds up a ton of intrinsic value over the next 3 months, then you could sell for a high price and collect a good profit. So for that reason, options that are further out in the future are worth more. They have more extrinsic value. Now, this days till expiration does not work alone. It also works with something called implied volatility. We'll talk more about implied volatility in a future section, but for now we can think of implied volatility as the anticipated future volatility of the underlying stock. In other words, the anticipated depth of swings that the stock price will have. If a stock price is very volatile, it can have a higher potential to push this option deeper in the money. So the more time you have till expiration and the more volatile the underlying stock is, the higher the likelihood that this option will swing very deep in the money and build up a large layer of intrinsic value. And because of this, this has to be priced into the option. There has to be some value given to the option because the intrinsic value can change. And it can change depending on days till expiration and implied volatility. Now, when we think about this logically then, there's two things we have to consider. One is that as time passes, there's less time until expiration, which must mean that extrinsic value decreases. And that is exactly the case. As each day passes, this extrinsic value is going to decrease by a certain amount. And we'll discuss what that certain amount is later when we talk about the Greeks, which are the option statistics. But for now, let's think about what happens if 1 day goes by. This can go down to 16 cents because there's less time for till expiration. There's less time for this option to get deeper in the money. That'll make the overall value of this option $2. Another day passes, it could drop down to 15, making it $1.99. So you can see that if you bought at 201 and the stock price trades sideways, meaning that the stock price stays the same over time, which means that intrinsic value stays the same over time, extrinsic value will decay, reducing the price of your option such that if you bought at 201 and then sold at 199, you would lose 2 cents of premium, which is $2. Buying call options is not just like having leveraged shares, owning shares for cheaper. There's characteristics to options that are unique to options, and this is one of them, called time decay. The fact that extrinsic value decays off as time passes is something you have to consider when you're trading options. You want that time decay to be compensated by an increase in intrinsic value. If intrinsic value increases more than extrinsic value is decaying, you will overall be making money because the value of your option will be increasing. So we want intrinsic value to increase, which happens when the underlying stock price rises, which will increase the overall value of this option. One thing that will negate this or impede this is the fact that extrinsic value decays over time. So we'll write that here. So looking down here, extrinsic value decays as time passes. This is called time decay or theta decay, and we'll discuss theta later. Another thing we have to consider logically looking at this is that, well, if the expected volatility, the anticipated volatility, the implied volatility, if that increases, well, then it has a higher potential to shoot this option deep in the money. So if implied volatility increases, extrinsic value increases, and vice versa. If implied volatility, if people expect that the future volatility of the stock is going to be less than they initially thought, which means implied volatility decreases, extrinsic value must decrease because it has less of a potential to shoot this option deep in the money. So there's a positive correlation between implied volatility and extrinsic value. Extrinsic value and implied volatility are positively correlated. Now, the interesting thing is we will look at how we use implied volatility as an edge when we're trading options in a little bit, but implied volatility is actually extracted from extrinsic value. So first you'll see an increase in extrinsic value, and that is due to an increase in implied volatility. People expect the future stock to be more volatile. There becomes more demand for this option. And because of the laws of supply and demand, the value of this option must increase. So as demand increases, as anticipated volatility increases for the stock, the price will increase, which means extrinsic value increases, which means implied volatility increases. So an increase in extrinsic value is the same as an increase in implied volatility. They are basically the same thing. Implied volatility means that there's volatility that is implied by the increase in extrinsic value. It is implied by the inflation of the price of this option. It is implied volatility, and it is implied by extrinsic value. But a lot of times you'll see people look at implied volatility and say, well, if implied volatility rises, that means that the options price rose. It doesn't work that way. It is implied by the increase of the options premium, which is caused by an increased demand for the option. Okay, so I'm going to leave it there for that section because there's a lot to take in, and we'll discuss more about implied volatility in a little bit because it's a little bit of a topic of its own. But let me summarize all this for you really quick. Options premiums are broken down into two subcategories. The first is whatever you could exercise the option for, and that is called intrinsic value. If someone's selling a button where if I hit it, I get $70, but they're selling it for $30, that's an easy $40 profit. I pay them $30, smash the button, get 70 back. $40 profit. Wouldn't make sense. This is a ticket. This option is a ticket to at least $184. So that has to be priced into this option, and it is. And it's priced in as intrinsic value. Out of the money options, because they cannot be exercised for any value, have no intrinsic value. However, this does not completely explain premium. There's also a second subcategory called extrinsic value, which is based on days till expiration and implied volatility working together. You must have time and you must have volatility for this option to be able to get deeper in the money. Extrinsic value decays as time passes. The less time there is till expiration, the less time the option has to get deeper in the money. Extrinsic value and implied volatility are positively correlated. If extrinsic value increases with no change to the stock price, it is simply due to implied volatility. Or in better words, there is implied volatility by an expansion in extrinsic value. If there's higher demand for this option and that demand, based on the laws of supply and demand, push up the price of this option, that means that there is a higher implied volatility, implied future volatility for the underlying stock. Any inflation in extrinsic value means that people expect an increase in volatility, or at least there's a demand, more demand for this option. And again, we'll touch on that later. Okay, so hope you're taking notes. I know this is a lot to take in. Let's go through some questions and then we'll move on to the next section. Define extrinsic value and intrinsic value in your own words. What do they mean to you? How does the amount of time until expiration affect the price of an option? If there's more time, is the option more or less valuable? If there's less time, is it more or less valuable? And explain why as well. How are extrinsic value and implied volatility correlated? And I want you to pause and answer this to yourself right now and think about it, because I'm about to give the answer to you so I can give you a little bit more detail on this question. So I'm assuming you're done now. Implied volatility and extrinsic value are positively correlated, but this is the real detail of the relationship. It's kind of confusing to think about. If extrinsic value increases, everything else held constant, meaning the stock price is held constant, because changes in the stock price relative to the strike price can change extrinsic value, but we're going to touch on that later. Forget about that. Everything else held constant. If extrinsic value increases, it is because the demand for the option has increased. Due to the laws of supply and demand, if there's more demand for anything, that anything is going to be able to be sold for a higher price. So if there's more demand for bread, it could be sold for a higher price. If there's more demand for PlayStation 5s, they could be sold for a higher price. If there's more demand for this option, it is going to be worth more. So if extrinsic value increases, it's because the demand of this option increases. And it is assumed that the demand for this option increases because the expected future volatility of the stock increases. Okay, so summarizing, extrinsic value increases. That means it's because people think the stock will move more in the future. So implied volatility is actually the volatility implied by the inflated options price, by the increase in demand. So it's an actual metric. Implied volatility is an actual metric that is extracted from the inflation of extrinsic value, and it gives a percentage move of the underlying stock over the next year that is implied by the inflated extrinsic value. And that is done through a model called the Black-Scholes model, which we're not going to touch on today. But that is the relationship. As extrinsic value increases, it is implying future volatility. And you can actually extract that implied volatility out of that inflated options price. Okay, so that's the correlation. They're positively correlated. As the price grows, it is implying a more and more volatility in the future, which means it could go, if extrinsic value grows a bunch, there could be an implied 20% move, which means 20% to the up or downside over the next year. So that's the relationship. And we're going to discuss more about implied volatility, but I think it's important that you wrap your head around that relationship now. Okay, if you have those questions answered and you're ready to move on, and you stewed on that for a little bit, let's go ahead and move on to the next section. All right, so this section is going to be kind of a quick one. We're talking about why exercising your call option is stupid and a waste of money. It's a little misleading when you're first learning about options, because everything you learn about options relates in some way to exercising that option. And then to hear that exercising is, generally speaking, in most situations, pointless is kind of brain breaking. But once we break it down, it's not brain breaking. So let's break it down. Okay, so here we are. We're looking at the same thing we were just looking at in the previous section. Okay, we've taken this 95 strike call. We're looking at the premium here of $2.01. That's written over here. And we've divided it into intrinsic value, which is whatever you could exercise for, whatever value you get out of it by exercising, and extrinsic value, which is whatever's left over and is due to days till expiration and implied volatility working together, time and implied volatility. This is all we need to really demonstrate why exercising your option, generally speaking, is pretty stupid. And we'll also explain what happens at expiration, the possible outcomes if you hold an option to expiration. Okay, let's think about what happens here. Of course, later we'll talk about how you actually buy and sell these options on the platform. But for now, I just want you to assume you know how to buy one. Let's say we buy this option for $2.01. Okay, so we're going to pay a $2.01 debit. That'll be taken out of our account. Okay, that goes to the option seller. They sell us the option. We now hold the contract in our clammy little hands, and we can exercise it or we can sell it. We can do whatever we want with it. Let's say we aren't very smart and we didn't know that you're not supposed to exercise an option, and we think, well, I just bought an in-the-money call option. I know that if I exercise, I can extract some value from that option by exercising. And what some people might think is, when I say value, they think profit. And that's not what I mean, but they might think I can extract some profit by exercising in the money option. And that's not true. But let's say I think that. So I buy this paying $2.01 and I exercise this call option. Well, what happens? I exercise it. This money right here, this debit, stays with the option seller. I never get it back. That $2.01 stays with the option seller. Okay? Unless I sell this option, I don't have money coming back through the door. So $201, remember this is in premiums terms, so $201 stays in the seller's pocket. I exercise. Well, how much money do I get out of this by exercising? Well, I get $184. We've already established this in the previous section, but this 95 strike call is $1.84 in the money, which means if you exercised buying 100 shares at 95 and selling 100 at 96.84, you would get $184 by doing that. Just to clarify, exercising is simply you exercise your contract, and when you do that, you click a button on your brokerage that says exercise, you buy 100 shares at 95. Okay, now we assume you go and sell those shares at 96.84. You would extract $184 of value out of that. And you can see that here in intrinsic value. Okay, intrinsic value is whatever you can exercise for, and that's $184, or in premiums terms, $1.84. So we paid $201 for debit to get this options contract in our pocket. Then we exercise, and we get $1.84 per share of the 100 shares back when we exercise. What's left? $201 out the door. We exercise, we have 184 coming in the door. We have 17 cents less than when we started. That's no good. We lost $17 by buying this option and immediately exercising it, even though it was in the money. The fact that it's in the money means simply that when you exercise it, you get some money back. It does not mean you get a profit. And notice how the 17 cents is exactly equal to extrinsic value. And that is because when you exercise, all you get out of it is intrinsic value. That is literally the definition of intrinsic value, is the value you get through exercising. You don't get the 201, you only get 184. So if you buy this option for 201, why would you exercise it, giving up extrinsic value, collecting only intrinsic value, when you could sell the option to somebody else for the entire value of $2.01? Remember, when we buy this option, we can sell it. Just like with shares, we can buy shares and we can sell shares. Same deal here. When we buy this option, we can sell it to somebody and we can sell it for the full value it's worth. And if we exercise it, that's going to be really dumb because we're only going to get this much back instead of 201. So we're selling ourselves short by exactly the amount of extrinsic value. So in summary, when you exercise, you give up extrinsic value. So now if we think about it, if we give up extrinsic value when we exercise, in what scenario would it be wise to exercise? Well, there's one that comes to mind, and that is when you are at expiration and for whatever reason you've held this in the money option into expiration, into closing bell on expiration day. The stock market's closed. It's too late. You can't sell this option anymore because options contracts, their prices lock up at close for most underlyings. So you can't sell it. Well, if you don't exercise this option, it's going to expire worthless, meaning that the money you paid to the seller stays with the seller and that's it. Your contract becomes void, null, it disappears, you lose the money you put into the trade. So you would want to exercise to prevent it from expiring worthless, to extract this intrinsic value. Plus, you don't really lose extrinsic value because remember, extrinsic value decays to zero by expiration. So at expiration, if the stock price stays exactly where it is right now, this option will be worth $1.84 in premium because extrinsic value decays to zero by expiration. So if you exercise, you're going to get 184 back. If you could sell, you would get 184 back, but you can't anymore because the stock market is closed. The options contract is locked. You can't trade options after hours. So the only thing to redeem yourself, to save this option from expiring worthless, is to exercise and extract that intrinsic value. You would buy 100 at 95, and then next market open, you could sell at the current trading price. So that's one scenario in which you would exercise and in which giving up extrinsic value doesn't matter because there is no extrinsic value. It's not a big deal. That's one of the rare situations in which you would exercise your option. Generally speaking, you don't want to hold your option to expiration. It's better just to sell right before close if you're really going to hold it that close to expiration. You really shouldn't be holding it that close to expiration anyway because the rate at which extrinsic value decays increases exponentially within the last 30 to 45 days. And we'll talk about that more later. But if for whatever reason you have an in the money option and you're in expiration, you hear closing bell and you're like, oh crap, I forgot to sell it. That's a situation where you could exercise to prevent it from expiring worthless. And you don't really have any cost by doing so because you have no extrinsic value left. So while we're on the topic of expiration, let me just run through the possible outcomes of expiration. Within the money, you would want to exercise it if you hold it into closing bell on expiration day. If you don't exercise it, it's going to expire worthless. You're going to lose the money you put into the trade. Whatever you bought that option for, that money stays with the option seller. You don't get that money back. And if you don't exercise, it's just gone forever. And your contract is now null and void. If you do exercise, you'll gain intrinsic value back. And since there's no extrinsic value left, it's not really that big of a deal. It's the best option in that scenario. With out of the money options, if you hold it to expiration, well, remember, out of the money options are completely consisted of extrinsic value. And since extrinsic value decays to zero by expiration, and because you can't exercise for any value, because like we mentioned before, you're plumb out of luck. If you hold an out of the money option to expiration, it'll decay all the way down to zero. And if you hold to closing bell, well, that's it. All the money you put into that option is now gone and you can't get it back. You can't exercise to redeem any value. Game over. Your trade's over. You goofed. There's no reason you should hold an out of the money option into expiration unless you just really want to delete all the money you paid for it. So those are the outcomes. In the money, exercise if you hold into expiration. If you don't, it'll expire worthless. Out of the money, if you hold into expiration, it will expire worthless. So let's summarize here. The reason you don't want to exercise a call option in general, there's really two situations, maybe three, that you would want to exercise. The first we mentioned, which is at expiration. The two other ones we'll mention down the road. But the reason you don't want to generally exercise a call option is because you give up extrinsic value. Because an options premium consists of both intrinsic and extrinsic value, when you exercise, all you're getting is intrinsic, which is less than the total value of the option. So you give up extrinsic value by exercising, you give up money, you leave money on the table. You actually would immediately have a loss if you bought a call option and exercised it immediately. You would incur a loss. So don't exercise unless you have a very specific reason and you know why you're doing it. And the one reason we discussed in this section would be if you, for whatever reason, hold an in the money option into close on expiration day, that is a scenario which you should exercise. We'll talk about 2 other ones down the road. In addition, we touched on what happens at expiration. If your contract's in the money, exercise it. If you don't exercise it, it expires worthless. You lose the money you paid for that option. With out of the money options, if you hold it into expiration, you're a total donut and you will lose all the money you paid for that option. Okay, so that said, I'm not really going to have any questions at the end of this since I just repeated everything I want you to know. We're just going to move right on to the next section. Let me show you how to find break even on WeBull before we start diving into what it is. So in the same options chain that we've been looking at pretty much this whole entire time, up in the top right-hand corner, there's a cog or something that looks like a cog. Go ahead and tap on that. Scroll down a little bit and you will see break even. Make sure that's added. Now, when you go back to the options chain, you can swipe to the left and eventually you will find break even. There it is. So for this section, we're going to be looking at all those numbers under break even and explaining what that is and its importance to trading options. All right, fellas, I want to pause for a second and look at you sitting at your computer. And I want to say, I'm proud of you. It takes a lot to slog through all this really dense information. So congratulations on making it this far, because you're making a lot of progress and it's going to put yourself above a lot of other people who just buy and sell options wildly without knowing what they're doing. So I encourage you to keep up your dedicated hard work and to see this through, because it'll pay off in the end. In addition, while we're paused, I might as well mention that if you want to make a few bucks, there are some links to different brokerages down below. If you sign up, they will give you some free stocks. So like Robinhood, WeBull, and Public are all brokerages that will give you free stocks if you join using the links below in the description. And if you're bored and just want to take a break for a second, there is Fantasy Invest, which is an app that you basically fake trade and compete against other people while markets are open. And if you trade well, you can earn prizes. So you can download that app and play down below in the description. Okay, with all that out of the way, let's go ahead and dive into one of my favorite sections, which is talking about break even. This is the first section where we're actually going to take a little bit of a step back and we're going to see things from a broader perspective and see how all the pieces we've already discussed work together. And this is the first section we're going to take a step back. There's plenty of more microscopic details we have to unravel and discuss as we go forward. But later towards the end of this tutorial, there's a few sections where we really take some leaps and bounds backwards and see the landscape practical view of everything we've talked about. And we'll see how everything comes together and works practically when you're actually trading these things. So if you feel like so far, like, yeah, I've learned little bits and pieces and little factoids or whatever, but I don't actually know how these things work from a practical perspective and how you actually trade them, don't worry, because you're not necessarily supposed to yet. And this is going to be your first taste of a step back where we'll see things from a broader perspective. As we define break even, it's still going to be kind of, we're going to be point blank, okay? A little microscopic looking at the screen, but at some point in the section, we will take a step back. Okay, all that said, let's dive in and talk about break even. Break even can be defined in 2 ways, and they're basically 2 sides of the same coin. They're 2 definitions that basically mean the same thing. The first is, break even is where this S sub 0, and S sub 0 means the current stock price, the stock price given 0 time passing, where this current stock price must be at expiration for you to break even, for you to have a 0 profit and loss, for you to have not made money or lost money. If we look at a call option, when you first buy a call option, the break even is right where you start. If you buy a call option, you can immediately sell it for basically the same price, so your profit and loss is 0. But when we talk about break even with a capital B, capital E, as it pertains to options, it has a specific definition. It has 2 specific definitions, which are laid out here and we're going to discuss. Break even with a lowercase b, lowercase e is just any stock price where your profit and loss is 0. In this case, we are talking about where your break even is at expiration. Your break even at expiration is not where you first bought the option. If you think about it, if I buy a call option right now and time passes, this option is going to degrade in value through that time decay that we talked about, that time decay that affects extrinsic value. Therefore, the overall value of your option drops. So you must recoup that by hoping the stock price rises, pushing your option in the money or deeper in the money and building up a thick concrete layer of intrinsic value. So intrinsic value must increase to counteract the decay of extrinsic value. And that's why your break even rises over time. Right now, today, your break even with lowercase b, lowercase e is right where you hopped in. At expiration, after all that extrinsic value has decayed off, your break even, the stock price at which you would break even, is much higher because the stock price must rise to grow intrinsic value to compensate for the loss of extrinsic value. That is the first definition of break even, is where the stock price must be at expiration for you to break even. The second is where the stock price must be in order for you to break even when you exercise. If you think about it, these two definitions are basically the same thing. It's saying in what situations is your intrinsic value enough to compensate for total loss of extrinsic value. If you exercise an option, you delete extrinsic value, just like we discussed. We are strictly looking at intrinsic value. What must the intrinsic value of your option be in order for it to compensate for the loss of extrinsic value? And that's what it means to break even. So this break even, these two definitions are specific to options, and it's a capital B, capital E. When I say that, I mean it's a specific definition that is talking about when there's no extrinsic value left. All right, to help illustrate this a little bit further so we get some visual representation of what we're discussing, what I have laid out here is a profit loss diagram for a call option. And let's go over the key over here, the notations. K, whenever you see K, that means the strike price of the option. S sub 0 means the current share price. C means call premium. And the blue line that you see over here is at expiration. The yellow line is before expiration. And this one in particular is talking about the day when you buy this call option that we're about to discuss. So if we look at this profit loss diagram, the y-axis is your profit and loss, and the x-axis is S sub 0, the current stock price. Any given stock price, that is the current stock price. So putting these pieces together, what we're looking at is your profit and loss at expiration for the blue line, given certain stock prices. So the blue line is what is your profit and loss at expiration. So for example, if the stock price is all the way down here at 0, your call option is going to be worthless at expiration. It's out of the money. All that extrinsic value is decayed off. It's worth 0. And so if we follow that down to the blue line and follow it over, we've lost $500. This yellow line is your profit and loss on the day that you bought the option. So what is your profit and loss on the day that you purchased this option that we're going to discuss, given a certain stock price? So the option that is in question here is a 95 strike call, and the premium we pay for this is $5. So you can see all in this section right here, which correlates with all of these stock prices, we incur a loss of $500, the entire value of this option at expiration, looking at the blue line. Past this point, you can see that our profit starts to rise such that maybe at this stock price, if we follow it down and follow it over, maybe we're at a loss of something like minus $200. So we've recouped some of the money that we spent to buy this option. So I want you to think kind of for a second, where must our strike price be relative to the stock price at expiration for us to lose all of our money? And it sounds like a mouthful, but the answer to this is that our option must be out of the money if at expiration it is completely worthless. So you can see that in this whole flat area, we've lost everything. Past this, the higher stock price, we start to recoup some of those losses. So that must mean that our strike price is right here, right where this blue line starts to bend. So our strike price of 95 is right here. If the strike price is $95, when the stock price is anything below 95, we've lost everything we put into the trade at expiration because extrinsic value decays to 0. Above that, we start building some intrinsic value because this option becomes in the money. And intrinsic value does not decay. It does not disappear. So at expiration, we are going to have some value left. Now let's look at this yellow line here. This yellow line represents your profit and loss before expiration. The reason that it's higher than the blue line is because any time before expiration, your option is going to have some extrinsic value, some time value. So it will be worth more. And as time passes, the extrinsic value decays. So before expiration, your option at any given stock price is always going to be more than if it were any day in the future, in this case, expiration day, which is this blue line. So for example, right here, if the stock price is right here, we'll say this is $90. We'll follow this down, follow it over. At expiration, we've lost everything we put into the trade if we paid $500 for this option. That is because extrinsic value completely decays and this option is out of the money, completely consisted of extrinsic value, so it decays to 0. Before expiration, in this yellow line, we're looking at the day we purchase this option, it's going to be worth more than that. We won't have lost everything we put into the trade if the stock drops to $90 the day we buy this call. If we follow it down to the yellow line and then follow it over, we might be at a loss of something like, again, minus $200, but we haven't lost everything yet. However, if the stock stays at $90, as time passes, as extrinsic value decays, this line will start shrinking, converging onto this blue line until it becomes the blue line. And at expiration, you have incurred your total loss of $500. You know, intrinsic value is like this thick cement block. On top of it is extrinsic value, and extrinsic value evaporates over time. At expiration, extrinsic value is totally gone. All that water's evaporated, and all you have left is that cement block of intrinsic value. And that's exactly what this yellow represents. This whole area underneath this yellow line is extrinsic value. And it will eventually decay off until, you know, it shrinks and shrinks and shrinks until it is this blue line of intrinsic value. Now let's discuss break even on this profit loss diagram. This is our strike, right? We've already mentioned that. Well, let's say, remember, this yellow line is the day we buy this option. What is the stock price or our break even with a lowercase b, lowercase c when we first buy this option? Well, it's right here. That might be something like $95.58. Okay, that's the current stock price at which we purchased this option. So it could be $98.58. It could be anything above 95. I don't know the exact numbers for this option. Okay, it's wherever you got in. If you buy a call option right now, you could sell it again. It's for the same price roughly. So your break even with lowercase b, lowercase c, not pertaining to these definitions, where your profit loss is 0, is going to be right where you first bought the call option, whatever the stock price is at the moment you buy that call option. Now, as time passes, you can see that your break even extends higher to the point where as this yellow line converges on this blue line, these blue lines here, your break even rises to this point. And that point can be calculated. Break even equals the strike price of your call option plus the premium you paid. The reason the stock price must rise is because, like we mentioned, we have to start accruing some intrinsic value to compensate for the decay of extrinsic value. Because if we stayed right where we entered right here, at expiration, we'd be down here and we'd have a loss. The stock price must rise and start accruing some intrinsic value in order for us to stay at break even. And if it rises even further, we can start getting a profit. And the reason that the break even is strike price plus premium paid is because when we pay that premium and it's gone, we have to recoup that money somehow. We have to at least make sure that our option is worth the same amount of money we paid for it in order for us to break even. For that to be the case when extrinsic value doesn't exist anymore, we have to have intrinsic value equal to however much we paid for the option, which is $5. If we want our call option to equal $5 of value at expiration, it must be 5 points in the money. And in that case, the stock price must be 100 in order for us to break even at expiration. And we can see that strike price, which is 95, plus premium paid, which is $5, equals 100. The value that's left is equal to what we paid, the money we paid to the option seller. So if we wanted to sell at the last moments of right before expiration, or if we wanted to exercise, we would extract $5 of value, which is exactly how much we paid for the option. And so we would break even. So break even, we look at strike price plus premium paid. It is basically our goal. It is where we want the stock price to go above at some point before expiration. The sooner, the better. Let's visualize this in a more simple way by looking at optionsprofitcalculator.com. This is a website, optionsprofitcalculator.com, it's really helpful in seeing what your profit and loss could be in the future given certain stock prices. In this case, we're looking at AMD. Okay, the current share price for AMD is $95, almost 96. I'm looking at a 95 strike call, and you can see the total cost of that call option. And you can see that here in premiums terms. So here you can see what our profit and loss is as time passes. And you can see that right when we buy this option, okay, on the first day of this option's lifespan, our break even is right where we started. Okay, this black line represents the current stock price. So our break even is right where we started. As time passes, as we move forward into the future, the value of this option decays as extrinsic value decays. And so we must have a corresponding rise in stock price to mitigate that decay. And you can see that we have to start increasing our stock price in order for us to reach break even. Our break even is up here, which we can see is, let's see, break even is $120.50. The stock price must be at $120.50 in order for us to break even at expiration, or if we were to exercise. But as we've discussed, exercising is kind of stupid. So I like to think of it as just where we want the stock price to go by expiration. Whether we're going to sell just a few seconds before closing bell or exercise the option after closing bell on expiration day, there is no difference, but you wouldn't really want to exercise before expiration day anyway. So here you can see kind of visualized how extrinsic value decays and how you must have a corresponding increase in stock price to counteract that decay until at expiration you must be above strike price plus premium paid to recoup the money you paid for the option and to break even. Now, something to note now, we'll talk about later, out of the money options have very, very high break evens. Strike price plus premium paid. So if you have an out of the money option with a really, really high strike price, well, the break even is going to be really, really high as well. Let me go ahead and do that really quick, actually. So I can select, we're on June 17th, and we can choose a really, really far out of the money call option, hit calculate. Look at that break even. Okay, you have to go super high. The stock price must rise a ton by expiration. The benefit for out of the money options is they're a little bit cheaper, and because options are a defined risk strategy, you have less money at risk. But the odds of success are slim unless the option is going to rise by a ton in the future. So why would you buy an out of the money option? Well, the reason people buy out of the money options is because out of the money options are cheap, so you can buy a lot of them. And if you buy a lot of them, they actually give you more leverage than an equal value in the money option. We'll talk about that when we talk about the Greeks and talk about Delta. So they provide a lot of leverage. And if things move quick, let's say they go from 100 and things pop up 50% to 150, you've made $2,000 off of something that cost $800. So that's over 100% return. But you have to hope the stock price moves quickly. Within the money options, if I switch this to very, very deep in the money, they're very, very expensive. They still have quite a bit of leverage, but their break evens are so much lower. That means that the stock price does not have to rise as far over time in order for you to break even. And that's why I'm a big fan of in the money options. We're going to discuss this a lot more later, but I want to give you a taste of why you might buy in the money versus out of the money. Out of the money is more risky, but can have a higher payoff. In the money is less risky per dollar, but has less leverage than if you bought a bunch of out of the money options. Okay, let's call it there before I just blabber your ear off. This is getting out of hand. All right, questions. Can you remember the two definitions for break even as it pertains to options? These are textbook definitions. Break even is a word in the dictionary. It's also its own word as it pertains to options. Okay, capital B, capital E. How do you calculate break even? And why must the stock price rise over time in order for you to maintain a zero profit or loss? Those are my three questions. If you understand those three things, I think you have a good grasp on what break-even is, why the decay of extrinsic value is important to consider, and I think you'll be able to use break-even as a goal for the underlying stock over the lifespan of the option and know why you're using it as a goal. All right, with those three questions out of the way, let's go ahead and head into the next section. In this section, we're discussing why volatility is good for options and what implied volatility is and why it's important. It's an important part of trading options. I know we've briefly brought it up and mentioned it, but we haven't gone into all the nitty gritty in explaining what it is, implied volatility specifically. And we also haven't explained how you use it in trading. And it is actually a very useful tool in giving you an edge, increasing your probabilities of success when you're trading options, both call options and put options. These concepts we're about to discuss here will apply both to call options and put options. But again, we're going to discuss put options towards the end of this tutorial because there are so many similarities, it would get way too repetitive to do them side by side. Okay, so here we're looking at a stock chart. And on the y-axis, we have share price. On the x-axis, we have time, just like every single stock chart you've ever seen in your entire life. And we're going to draw out some share prices here over time. Let's say there's an area of low volatility. Okay, and then there's an area of high volatility. Well, why is this area of low volatility not so great for options? Well, when stock prices are trading sideways like this, when I say sideways, I mean trading with very little volatility across time, staying around the same share price over time. It's not good for options because that whole time the stock price is staying there, your option is not accruing any more intrinsic value and its extrinsic value is decaying. So you're not building up intrinsic value compensating for the loss of extrinsic value, that decay of premium. In fact, you're just experiencing the decay of premium. So as each day passes, as time goes on, you're just losing money. And with low volatility, there's a low probability that your option will be swung into the money or get deeper in the money, building up a lot of intrinsic value that cannot decay off. So it's bad. This area is terrible. You don't want to hold a call option to this area if you could foresee it, because you're just going to be losing money as extrinsic value decays off. But how about these areas of really high volatility? It gives the option an opportunity to be pushed in the money or deeper in the money quite significantly because the swings of the share price are so large. But what about to the downside, because yes, it can swing your option deep in the money. You could accrue a lot of intrinsic value and you could incur a lot of profit because the value of your option is increasing. Just like if you hold a share, if it increases in value, you're accruing an unrealized profit. But what about the downside? Bigger swings also mean bigger swings to the downside, right? It could push your option further out of the money. It could degrade the value of your option as intrinsic value decreases. So why is higher volatility good? Well, we have to remember the idea that options are a defined risk strategy. So for example, as the stock price swings up here, maybe my call is worth $5 in premium right here. And then it swings down, and down here it's worth $2. Well, what if it swings down here? Well, it might be worth 50. What about lower? Here it'll be worth 1 penny if it swung down here. How about even lower? Here it's worth 1 penny. Oh wait, how about even lower? Here it's worth 1 penny. An option can never be worth less than 0 or less than 1. It will be worth 0 if it expires on expiration day, but it won't be worth less than 1. Sure, there might not be very many buyers or sellers down here, but you won't lose more than the initial premium you paid for this option. So when you have high volatility, yes, there's a higher likelihood that you will lose all the money you put into the trade because it could swing you very far out of the money. But that risk is defined. And that is the exact opposite case to the upside. Your risk is undefined. This stock price could continue to rise to the upside indefinitely. And the entire time, the value of your option is going to be increasing as intrinsic value increases, and you'll be incurring a larger and larger unrealized profit, and it'll become realized if you decide to sell this call option. So because this is a defined risk strategy, and high volatility could swing you down and reduce the premium to 1 penny, it can't reduce to less than that. But to the upside, it can increase indefinitely. Therefore, volatility is good for options because it has a higher potential to swing you indefinitely to the upside. But if it swings you to the downside, well, you just lose whatever you put into the trade. That is why volatility is good for options. So because volatility is good for options, if there is an increase in volatility or an expected increase in volatility, options premiums will increase. The fact that volatility is good for options must be priced into the option. We're going to draw something that looks pretty familiar, kind of looks like that profit loss diagram we were just looking at before, but it's actually called a premium diagram because we're not looking at profit and loss this time. We're just looking at call premium. And remember, C denotes call premium. All right, so this time we're just looking at call premium, where here at the bottom it's worth 0. Okay, up here for blues at expiration, at expiration up here it might be worth $1. Who knows? So we're just looking at call premium here. With what's called implied volatility. Implied volatility is simply an expansion of extrinsic value because people think the stock will be more volatile in the future, or just in general, demand for the option has increased. Okay, so that if the stock price is right here, it might be worth $1. Okay, we're gonna say it's worth $1. Now, if people expect that the stock is gonna be more volatile in the future, or there's increased demand for options for whatever reason, for hedging purposes, hype, just for whatever reason, this extrinsic value is going to expand. So it'll look something more like this. Where it was once worth $1, it's now worth something much more. Might be worth $2.50. Not because the stock price changed, okay? Doesn't have anything to do with the stock price. This is just an increase in expectation that the stock will be more volatile, or just increase in demand for the option, which expands extrinsic value and makes the option more valuable. People will call this an expansion of implied volatility. There is future volatility that is implied by the increase, the expansion, the inflation of extrinsic value. Because the option became more valuable for no other reason, it must be due to the fact that there's an expectation, an implication of volatility in the future. And so you'll see this written as a metric. You can actually extract the expected volatility based on how much the options premium is inflated. So this expansion in volatility might represent a 25% move in the underlying stock over the next future, which would be to the upside or downside. So if I have a stock chart right here, you might see it represented as 25% to the upside and 25% to the downside. And that is implied by the inflation, the increase in demand for this option. Remember, an increase in demand increases the price of an asset due to the laws of supply and demand. So we can actually use this to our advantage. If we are able to buy this option for $1 right here, and then not much time passes, the stock price doesn't really move, but the demand for the option increases and expands to 250, okay, increases to here. Well, now we've made $1.50 in return. So we've actually made $150 for no other reason besides the demand for the option has increased. And people will say that implied volatility increased. The implied volatility has increased, which means extrinsic value has increased, which means you made money because the price of the option increased. You bought at $1, you can now sell it for $2.50 in premium, so $250. So let's discuss how you can maybe predict when extrinsic value is going to expand, when implied volatility is going to expand, to give yourself an edge so that you can make money not only if the stock price goes up, but also if implied volatility increases. A lot of times you'll see charts of implied volatility, okay? It's represented as percentage moves of the underlying across over the next year. Okay, they're extracting the implied future move of the underlying from the inflation and the options premium. But you'll see that graphed out over time. So we'll put implied volatility over time. And let's just draw it out here, okay, like this. There's a concept called mean reversion that applies to a lot of things in life, but specifically applies to both implied volatility, and I mean, you'll hear day traders talk about it a lot. But it's the idea that anything outside the average will eventually return back to the average. And this applies to implied volatility in a way that we can utilize. If we draw a line that kind of represents the average, like if it were a regression line, for instance, we can say that this is below the average and this is above the average. So that if we buy a call option where an implied volatility is low, so we buy an option here for $1, well, we expect that it will return back up to the average, which is this line, represented by this line. It has a tendency to return to the average. It's more likely that it will go back up to the average than it will keep going down. So because of this tendency, we can expect, or reasonably expect, that if we buy when implied volatility is low, we can expect implied volatility to increase. And in this case, it does, rising back up to the average, such that right here, your option might be worth something like $250, as we discussed before. So we can use this idea of mean reversion and the fact that an increase in implied volatility is basically the same thing as an increase in extrinsic value, which means an increase in premium of your option, which means you can incur a profit. So we can take the idea of mean reversion and the idea that options premiums increase with an increase in implied volatility and combine them together to give ourselves an edge so that we not only make money when the stock price rises, but also if implied volatility rises. And I'm going to show you how you can, a tool you can use to help find stocks that are in this region of low implied volatility so you can give yourself an edge. And it works against you too. If you buy in an area of high implied volatility up here, and maybe you pay $5 here, well, if it reverts back to the mean, that extrinsic value is going to decrease, the value of your option is going to decrease, and it might be worth something like $3 down here. So you don't want to buy in areas of high implied volatility. Now, that said, if the stock price rises substantially, it could negate this effect. Okay, so maybe if, yeah, sure, implied volatility decreased, but if the stock rises 50%, this could be worth a ton of money. So the only reason you want to buy in low implied volatility situations is just to give yourself an edge, to increase the chances of making money, or to curb your losses if things go down. Your main goal, however, when you buy a call option is that the stock price rises and you incur a lot of intrinsic value and you sell for a profit. Let me show you a tool that you can use to sort through stocks to find ones that are in low implied volatility environments if you want to give yourself an edge. So the tool I use to find stocks that have low IV, implied volatility, is through Tastyworks. They're their own brokerage. Okay, so in order to use this tool, you do have to sign up, and you can sign up using a link below in the description. It doesn't cost anything. You can use your trading platform and use this tool I'm about to show you. So I highly encourage that you do so. Okay, and they're actually a pretty good options-focused brokerage. So if you decide to use Tastyworks to trade at any point, and you're going to be depositing at least $2,000, you can use the link below, and it will help out the channel as well. But more importantly, let's focus on what tool we can use to find environments of low implied volatility so we can capitalize on that mean reversion characteristic of implied volatility. To do this, sign up and then sign in, and you see this guy's god-awful face. It is just terrible. It's been here for years. I wish they would get rid of it. It kills me every time I see it. I honestly just want to die. And then you click on trading platform. Go ahead and log in, and on the left, click on grid. Here you can see a bunch of different stocks laid out, and you can change what stocks are shown. But what we want to focus on here is something called IV rank. What IV rank does is it ranks the implied volatility of the underlying between 0 and 100, where anything above 50 is high relative to its historical average. Anything below 50 is low relative to its historical average. So obviously these underlyings are 0, 1, 4, 4, 5. Those are very, very low implied volatility environments. They might have a tendency to for the implied volatility to rise back up to the average, and you can make money as it does so. So low implied volatility is great for buying options in. Now, something we'll talk about later in a future section is liquidity. And even though these underlyings have low implied volatility, their liquidity may not be so great. So they may not be the best for trading options on. We'll talk about that later. But this is a great way. If I click on IV rank, I can sort from highest to lowest. So I can find high IV, which we're not really interested in. I just want to find a stock that has low implied volatility and use that as an edge. You also, of course, want the stock to go up. So that is your primary thesis, is that the stock will go up if you're buying a call option. And your break even is going to determine how high up you think it's going to go. But low implied volatility will give you an extra edge and increase your probability of success. And this is a useful tool to finding low implied volatility stocks. When you look at implied volatility that's graphed out like we saw before, or we're looking at IV rank, it's looking basically at the average at the money implied volatility. Okay, so even though all options will have their own implied volatility, it kind of smooths it out, averages it out. Okay, so feel free to use this. There may be other sources where you can see implied volatility graphed out historically, but the sources I once used to see a historical graph of implied volatility are now, you have to pay for it. And I'm just unwilling to do that. So I recommend you use this. All right, got some questions for you. Questions for implied volatility. What is implied volatility? Why is it called implied volatility? What is it implied by? Why do we want to buy options in low implied volatility environments? And do we make money as implied volatility increases or decreases? What portion of premium expands and contracts when implied volatility increases or decreases? All right, if you got those questions, let's move on to the next section. You've made it very, very far through this tutorial, and you've made it through a lot of the very, very dense material. This is the last section that I feel like will have some pretty dense information in it. So I encourage you to really engage your brain for one more section, and then the following sections will be pretty easy and won't require so much thinking power. So put on your thinking cap, engage your brain, and get ready to focus, because there's important information in here that you don't want to miss. As always, I will do my best to explain it in bite-sized chunks. Okay, so this section we're talking about something called the Greeks. The Greeks are option statistics that define how options prices change. And they're called the Greeks because these statistics are named after Greek letters. Let's go ahead and dive in, and it'll make sense as we go here. So I've taken a screenshot from the desktop platform. You can add the Greeks, which are delta, gamma, theta, vega, and rho, on the desktop platform by selecting this button and adding them. On your phone, you can select the cog in the upper right-hand corner of your options chain, and you can add them there. The first Greek we're going to look at is called delta. Delta attempts to define how your options premium changes given changes in the underlying stock price. We know that you make money as the stock price rises, and you lose money as the stock price goes down if you own a call option. And so delta defines exactly how much your option is going to change when the underlying stock price changes. My definition for delta is how much premium changes given a $1 move in the underlying. So if we look at this option right here, the 525 strike call option, and we follow it over to delta, we can see that has a delta of 68 or 0.68. What this means is if the underlying stock goes up by $1, your option will increase by 68 cents. And that's in premiums terms. So if we talk about profit and loss, you would make $68. If the stock price goes down by $1, you will lose $68. So it defines how much you make or lose given a $1 change in the underlying stock. Delta is between 0 and 1, and it will never exceed 0 and 1. For put options, it will, because it's between 0 and -1, but we'll discuss that later. For now, with call options, it's never less than 0 or greater than 1. The further in the money you get, you can see as our strike price decreases, see our strike price is going down there, you can see that delta increases. As you get further out of the money or less in the money, your delta is going to shrink. When you're really, really far in the money, like way up here, let's pretend that this options chain continues upwards, you're way up here, you're going to have a delta that is very, very close to 1, where if the underlying stock rises by $1, you'll make $100 and vice versa. As you get very, very far out of the money, it's going to approach 0 to to the point where you're not going to make a whole lot of money if the stock rises by $1 or lose a lot of money when the stock goes down by $1. Now, there's a really good reason why this is, why it's between 0 and 1, and why it decreases as your strike increases and why it increases as your strike decreases. But we have to go back and take a look at intrinsic value. I know you're probably sick of me talking about extrinsic and intrinsic value, but they're fundamental to everything options. So to kind of explain why delta works this way, because it's very commonsensical. It makes logical sense. Let's take a look at an example. Let's say we have an option whose call option whose strike is 100. Let's say that the underlying stock price is 101. Well, we know exactly how much intrinsic value is here because it's $1 in the money. If it's $1 in the money and I exercise, I'll extract $100 of value, or written in premiums terms, I'll extract $1 of value. And that's exactly what intrinsic value is. It's whatever you could exercise it for. So this has $1 of intrinsic value. It's also going to have some extrinsic value if it's sometime before expiration. So we're just going to attribute a random number to this because we can't exactly, this isn't enough information to determine how much extrinsic value this option has. So we're going to say this option has 30 cents of extrinsic value. So what's the total value of this option? Well, if we just add these two together, intrinsic and extrinsic, we have $1.30. So if you wanted to buy this option, it would cost you 130 bucks. Okay, so what happens if the stock price rises then? Well, let's write out our strike here again. We'll say the strike is 100, same option, same underlying, just time has passed and the stock price has risen. And we'll say the stock price is 102. Well, we still know what the intrinsic value of this option is because it's $1 further in the money, which means we have $1 more of intrinsic value because we can exercise for $1 more of value. So the intrinsic value of this option is $2. However, something interesting happens to extrinsic value. It doesn't stay the same. Yes, we talked about how extrinsic value is based on time to maturity and implied volatility, but it also changes depending on where the strike is relative to the stock price. As you get further in the money or further out of the money, in other words, as you get away from at the money, extrinsic value shrinks. In other words, extrinsic value is highest at the money, and as you get away from at the money, it shrinks. And that's represented by those triangles there. So if we're getting further in the money here, we know that this extrinsic value has to shrink. The reason for why extrinsic value is highest at the money is because there's more emphasis put on time till expiration and implied volatility for at the money options. Because those two things, which constitute extrinsic value, are going to determine whether or not these options end up in the money. If you're out of the money, there's more certainty that they're just going to stay out of the money. If they're in the money, there's more certainty they'll stay in the money. But if you're at the money, there's a lot of uncertainty, and what determines the fate of those options is going to be implied volatility and time until expiration. So there's more premium given to the option, more extrinsic value for at the money options. As you get away, that extrinsic value shrinks. So in this example, our extrinsic value might be something like 25 cents, such that the total value of this option is, $2.25. So what's the difference between these two? Well, the difference between these two is not $1, it's 95 cents. This characteristic of options, the idea that extrinsic value shrinks the further away you get from at the money, explains exactly why delta is not equal to 1. If this were not a thing, if extrinsic value changing were not a thing, all of these deltas would say 1. I mean, if we think about it, if we ignore these two things, we get $1 in the money, well, we accrue $1 more of intrinsic value. But because extrinsic value shrinks the further in the money you get, it's going to curb some of those gains. So that instead of going from $1.30 to $2.30, we've gone from $1.30 to $2.25 because extrinsic value shrunk by 5 cents. So that explains why all of these deltas are not equal to 1. But as you get really, really far in the money, the extrinsic value is going to be so small, there's not that much left to shrink off as you get further in the money. So your delta is going to be very, very, very close to 1 because this shrinkage of extrinsic value is going to be curbing less and less of your gains from intrinsic value. And the shrinking of extrinsic value explains why premiums for out of the money options are continually decrease the further out of the money you get because they completely consist of extrinsic value, and extrinsic value shrinks the further out of the money you get because there's more certainty that they'll stay out of the money. So they're just cheaper. There's less hopes that they'll have an opportunity to build up intrinsic value, which you want to build up in order to get above break even by expiration. Okay, and this idea that extrinsic value is highest at the money will play into more complicated strategies like spreads, and they'll also play into some other Greeks here in a minute. Let me clean this up. Next up is gamma. Gamma is to delta as delta is to the underlying. Gamma explains how much delta changes given a $1 move in the underlying. So as we said, because extrinsic value shrinks the further in the money you get or the further out of the money you get, we know that delta must change too, because as this extrinsic value shrinks, maybe right there's not that much left to shrink off. So it's gonna be shrinking by a smaller and smaller amount, a smaller and smaller factor. So delta therefore increases as you get in the money and decreases as you get out of the money. And gamma defines exactly how much delta changes by given a $1 move in the underlying. So if we look at this 525 strike call and we follow it over to gamma, we see that's 0.01. To the upside, it'll increase by 0.01 if the underlying increases by $1. It'll decrease by 0.01 if the underlying decreases by $1. Gamma, in my opinion, not super important. Delta is much more important than gamma is. Next up is theta. Theta is how much premium decays as each day passes. It's how much extrinsic value decays by as each day passes. We know that with less time until expiration, there's less time for that option to get in the money or get deeper in the money, which means there's less time for the option to start building up that concrete block of intrinsic value that we're all seeking. So therefore, the price tag of the option is going to be reduced, and that is represented as a decrease in extrinsic value. And that happens as each day passes. Theta is constantly degrading the value of this option. And this is written in premiums terms as well. So what this is saying, theta is saying that this option is going to decrease by $70 as each day passes. And it's pretty high. $70 is pretty high for this option. We can see that it's roughly worth between $1,300 to $1,500. We'll discuss a bid ask in a little bit. But it's pretty high because we're really, really close to expiration. And there's something unique about theta that you need to understand. So let's graph out call premium here against time. Call premium stays relatively flat. Okay, extrinsic value does not decay all that much for quite a while. By the time you hit about 1 month out, 30 to 45 days out, something kind of bad happens, and that is that extrinsic value quickly decays off. And if your option is out of the money, it'll decay off at expiration to 0. So there's this pivot point at 30 to 45 days out where theta really starts to ramp up, and the value of your option will decay quite quickly. You'll start losing money quickly, and you have to hope that the stock price starts moving quickly to get above your break even. Otherwise, you're going to end up at a loss, or if it's out of the money, you're going to end up at a total loss. So when you look at theta, think, am I willing to pay that much each day in hopes that the underlying stock will rise and I'll make money with this call option? Theta is going to be a smaller percentage of in the money options premium, and it'll be a larger percentage of out of the money options premiums. So yes, the number itself, if we look at down here, we can see that it says 71 at the very, very bottom. You can barely see that. It says 71. Up here it says 75. So yes, out of the money is going to have a smaller theta. It'd be more significant if we could see further out strikes, but it's going to be a larger percentage of the value of the option. So if I buy a bunch of out of the money options that were worth the same price as a single in the money option, which is more expensive, this bunch of out of the money options is going to have a lot more theta. And that's why when we discuss break even, we could see that the break even rose really quickly for out of the money options. And that's because theta really degrades the value of out of the money options quickly, because theta affects extrinsic value, and out of the money options consist entirely of extrinsic value. So their entire premium, all of it, is decaying, while within the money options, they have intrinsic value, which is not decaying. It's also worth noting something about delta. With out of the money options, delta is a higher percentage. I'm just going to write this in shorthand. In the money, delta is a smaller percentage. So that's important to realize, because with out of the money options, delta is just going to be a smaller number. We can see here that it says 39. Up here it says 68 for the in the money option. It's higher than the out of the money option. But this 39 is a larger percentage of the premium of the option versus up here. So let's say I have an out of the money option that's worth $1, and there's an in the money option that's worth $2. Well, I could buy 2 of these and buy 1 of these for the same price. Okay, both of these equals $2, right? So I pay $2 for each of these. Now I have 2 in the out of the money options and 1 in the money option. Which one has higher leverage? Well, it's going to be the out of the money option, because delta is a higher percentage of the overall value of the option. My delta here might be something like 0.8, while my delta here might be something like 0.7, just as an example. So you have more leverage with out of the money options. If things move quickly, you can make more money than buying in the money options. But as we discussed with both theta and break even, out of the money options have very, very high break even. So if the stock price doesn't start moving quickly, the value of your out of the money options are going to decay very, very fast. While within the money options, yes, they're more expensive. Yes, they have less leverage as a percentage of the overall value, but their break evens are lower. So they're a less risky trade. There's a higher chance of success. And that is very important to consider, because a lot of times, if you've seen Wall Street bets, what they're doing is they're going out and buying really, really far out of the money options and hoping that the stock price moves an insane amount so that they can make money quite quickly. But what really happens is that the stock price doesn't move as much as they expect it to. And their out of the money options decay fast. They evaporate quite quickly. And in the money options, in my opinion, are much more preferable. They're more expensive. They have less leverage as a percentage of the value of their options. Still plenty of leverage though. But their break-evens are so low and their theta is so low that it especially with expirations that are far out due to that ramping exponential increase in theta we discussed, that they make it a very appealing investment strategy as compared to just out of the money options. All right, last one, ladies and gentlemen, or actually we got two more, but basically last one, because the very last one is stupid. So Vega, what is Vega? Well, I guess I'll write it out, huh? Sorry, it's getting kind of cramped here, but Vega is how much premium changes given a 1% change in implied volatility. So given a 1% move in implied volatility, how much does the options value change by? So if we look at this option right here, the 530, we follow it over to Vega as a 0.24. That means if implied volatility changes by 1%, the value of your option is going to change by 24 cents. So if implied volatility goes up by 1%, we'll make 24 bucks. If it goes down by 1%, we'll lose 24 bucks. Remember, we know that implied volatility or volatility in general is good for options. So if anticipated volatility increases, so will our extrinsic value. And Vega defines how much it increases by. And you can see that Vega is highest with at the money options. See how this is 24, but as we get in the money, it's 22, out of the money, 21. Because extrinsic value is the portion of premium based on days till expiration and implied volatility, Vega defines how extrinsic value changes based on changes to implied volatility. So Vega is going to be highest where extrinsic value is highest, which is found at the money. I mean, if we remember, we can draw out our call premium diagram, right? We have call on the y-axis, call premium, and we have stock prices on the x-axis. We have our intrinsic value. Sorry, I'm just going to shift the screen. I'm not going to worry about that. And then we have our extrinsic value. You can see that our extrinsic value, which we can shade this in, that's all extrinsic value. We can see that extrinsic value is highest at the money. If I drew this better, it'd be more obvious. Okay, it's highest at the money. At the money is right here. This is our strike price. When the stock price is equal to the strike price, then our option is at the money. And our extrinsic value is going to be the highest. And when we have changes to implied volatility, this area expands. If implied volatility increases, our extrinsic value increases, this line expands upwards. And the part where you're going to experience the largest expansion is going to be right where your strike price is, right when your option is at the money. Changes to implied volatility are going to have minimal effect the further out of the money or the further in the money you are. Same with if implied volatility decreases. If it decreases, you're going to experience the largest impact at the center when your option is at the money. I might as well mention it now too. When you look at this line like this, the act of extrinsic value decaying, where this line shrinks down and further down until extrinsic value no longer exists, and all that is left is the blue line, which is intrinsic value. This process is called convergence. And is really a word given to everything we've been talking about today. The idea that extrinsic value decays until all that's left is intrinsic value, if there is any. If it's out of the money, there is no intrinsic value. So that process of that yellow line converging, that extrinsic value line converging on the intrinsic value line is called convergence. So if you want the most exposure to implied volatility, you would buy an at the money call option. Last one is called Rho. We don't really care about Rho. It doesn't really move the needle all that much. It says how much your option changes given a change in interest rates. And I forget if it's like a basis point or what, but it's so unimportant. It literally does not matter. You could delete it and never see it again, and you wouldn't be affected by it at all. Do not worry about Rho in the slightest. Everything else is relatively important. I would say delta is most important. Theta is important as well, to consider how much your option is decaying by. Are you willing to pay that much? I had an old professor that used to say theta is how much you pay to play every day. That's exactly true. Every day that passes, you're losing this much money. So you better hope that the stock price rises to outdo the money you're losing there. And you better hope that you get above break even. So you have a nice concrete block of intrinsic value that won't decay. So delta is important to examine your leverage. Theta is important to examine how much you're paying to play every day. Vega is important to take a look at your exposure to implied volatility. Gamma is not really all that important. We understand that delta increases as you get in the money and decreases as you get out of the money. The factor of at which it increases or decreases by, in my opinion, is not all that important. So these three, delta, theta, and vega, are the ones that you're going to hear the most about and the ones you should be paying the most attention to. All right, let's call it for that section. I think that's enough. All right, guys, some questions for you. Pretty straightforward. I just want you to be able to define delta, theta, vega, and gamma. Don't worry about rho. I really don't care about rho. I want you to point out which ones are the most important to pay attention to and why. Hint, it's going to be 3 out of 4 of them. And lastly, I just want you to know which type of option has the highest extrinsic value. Is it in the money, at the money, or out of the money? Okay, with those questions answered, let's move right along. And I know that one was especially brainy in my opinion. It's going to become less and less brainy going forward. So I hope that makes you happy. Let's do it. Okay, so we're working towards sections that are going to hurt your brain less. This one's still a little bit brainy, but it's less brainy than the other stuff we've done so far, in my opinion. Its importance, however, is exceedingly high. This is a very, very, very important section. And if you don't pay attention in this section, odds are you're going to get in a situation where you're losing money and don't know why, or you're going to leave a lot of money on the table. So this section is incredibly important, and I want you to pay extra special close attention to the topics we're going to discuss. And what we're going to discuss is the bid-ask spread and volume and open interest. To find these statistics, which we'll define here in just a moment, go to your options chain and tap on the cog in the upper right-hand corner. Okay, this is where you add or subtract any statistics you want to take a look at. So here you can see at the very top, you can see open interest, volume, bid, blast, and ask. And that's what I want you to be taking a look at throughout this section. Okay, this section is really important, so I want you to pay attention. Okay, it has caused a lot of newbies to lose money. It's caused a lot of beginners to leave money on the table. You can get stuck in a position that you don't want to be stuck in if you don't understand the topics we're about to discuss. So pay attention. All right, listen up. The bid and the ask are two different prices for the same thing. Shares have bid and ask. If you go try to buy a share of Microsoft, you're going to see a bid price and an ask price. The bid price is where the best available buy order is. It is the highest buy order. If you wanted to sell this option, that is the best available price that you could sell it at. The ask price is the best available selling price. It is the lowest price that someone is willing to sell this option for. And you might sometimes see it with a time symbol or an X, and it might say something like 50. And that means there's 50 sell orders at the price of $1.20. There might be ask orders that are somewhat higher. There might be buy orders that are somewhat lower on different exchanges, but all that's going to be shown when you look at the bid ask is the best available price. Who cares about a lower buy order? If you're selling, you want to sell at the highest price possible. Who cares about the higher ask order? If you're buying, you want to buy at the lowest price possible. These prices are generated by market participants like you and I, but a lot of the times they're generated by an entity called a market maker. Market makers are usually financial institutions or banks, some big boy with a lot of money, and they simultaneously enter a buy order at the bid price and a sell order at the ask price, and a bunch of them. And so as they get filled, where they buy at $1 and then they get filled over here and sell at $1.20, they're constantly collecting the difference between these two prices. And this difference between these two prices, which in this case is 20 cents, this is called the bid-ask spread. So these market makers are going to have to hold a lot of these options in their possession if they want to enter a bunch of ask orders here. So they do carry some risk by carrying those options, but they try to make up for the risk by also entering a bunch of buy orders on the bid side and collect the bid-ask spread over and over and over for a profit. This bid-ask spread will change. It'll expand and contract. It'll contract if there's more market participants, if there's more people buying and selling this option. The reason for this is because there's going to be more price competition. And with price competition, it's going to push the bid-ask together. You're going to get more fair prices on both sides. The bidders are going to constantly be trying to outbid each other, which is going to push the bid price higher, and the askers are going to constantly try to sell for a lower price, out asking each other, which is going to push the asking price lower, so the bid-ask spread will be tighter. And the situation in which the bid-ask spread is tighter, where there's more market participants, is when more options contracts are being traded. And if we come down here, that's exactly the definition of volume. Volume is the number of contracts traded per day. I really should say that day. So if you see volume next to an option and it says 15, so far for that trading day, that option, that type of option, that one with that strike and expiration, has exchanged hands 15 times. So the higher the volume is, the more price competition there is going to be, and the bid ask is going to shrink. And we'll discuss why that's important here in a minute. Open interest also ties in with volume. If there's a lot of volume, generally speaking, unless everyone's closing out their positions, there's going to be high open interest. Open interest is the number of contracts currently open. If there's high open interest, it likely means there's high volume. If there's high volume, it likely means that this bid-ask spread, or I guess I should put the arrow down here, this bid-ask spread is going to be tight. There's going to be a small difference between the bid price and the ask price. And this is good for you and I. Let me explain why. Let's think about how this works if this is the price of an option we're interested in. We have buyers lined up at $1. The highest bid price is $1 and the lowest asking price is $120. Well, where can we go and immediately buy this option? We can see right here in front of us the best selling price. We have to buy from someone who's selling. We don't join the ranks of the bidders. We have to meet an asker. We have to meet a seller wherever they're asking, and also for what price they're asking at. So in this case, if we bought this option and we wanted to buy it immediately, we'd meet the available seller and we'd pay $1.20. So that'd be $1.20 debit. Again, that's premium, so you pay $120 for this option. If then all of a sudden immediately I decided, you know what, never mind, I think I made a mistake, I would like to sell this option. Well, you can't sell it to the sellers. There's no buyers up there. You have to look at where the buyers are, which is on the bid side. And that's the best available price. It's the highest price that you can sell for. So if I went and wanted to sell it immediately, I would sell for the price that is listed as the bid price, which is $1. I'd sell that for $1, and that would be a credit. Overall, I would lose 20 cents of premium. That's why it's important to have high open interest, high volume, because that means it's going to push the bid ask together. And the smaller the bid ask is, the less money you're going to give up by getting in and out of the trade immediately, by meeting the sellers where they're at when you're buying and meeting the buyers where they're at when you're selling. So it's important to look at volume and make sure that there's high volume. You definitely want to see it at least in the hundreds. But generally speaking, the best representation of both volume and open interest, and in general liquidity, the ability to get in and out of the trade quickly, the ability to exchange an asset for cash, is by looking at the bid-ask spread and seeing how wide is it? Is it wide? Is it a large percentage of the value of the option? In this case, it is pretty large. You could say it's at least 20%. So you have to consider when you're looking and speculating about what your profit might be in the future, and we'll discuss how you do that in a little bit using options profit calculator. We briefly mentioned it before, but we'll dive more into that. So when you're thinking about what kind of profit you're going to get, you have to think about, well, am I willing to give up 20 cents just to get in and out of the trade at some point for the profit I'm going to receive or expect to receive by buying this option? Some options will have a bid-ask spread that is 1 cent wide. These options are great. That means that the option's liquidity is high, volume is high, open interest is high. It's a very popular underlying to trade options on. That's a good thing. If you have options contracts where the bid ask is hundreds of dollars wide, avoid it like the plague, unless it's a really small percentage of the overall value of the option. But generally speaking, that's going to mean there's low volume and there's low open interest and you have a wide bid ask. And that means, one, you're going to have to give up a lot of money just getting in and out of the trade. And two, it also means that there's a potential for volume to dry up entirely, in which case you'd be stuck with the option with no one to sell it to. And that is possible. It's kind of rare, but it is possible. Or three, you would have to sell it for just such a ridiculous price that you would lose so much money. Because if volume dries up, the bid ask will become even wider. And that might happen if your option becomes even more in the money, because the further in the money you get, or the further out of the money you get, the more liquidity drives up, the less volume there is. So if you buy a call option that's deep in the money with a wide bid ask and it becomes more in the money, liquidity might dry up, volume might dry up, the bid ask might become even wider, and you'll have to give up even more money to sell this option. So there's a lot of reasons why you want to look at the bid ask spread and make sure it's tight before entering an options trade. Another thing to keep in mind is that sometimes, for not really any good reason, the bid ask will expand wildly. Maybe all of a sudden there are no bid orders, and if there are no bid orders for even just a second, it's going to show that your bid price is $0. And if you bought this option for the original $120 debit, your brokerage is now going to show the middle price of 60 cents. So it's going to basically show that you have a 50% loss. If you paid $1.20 and now this option is listed at 60 cents, you have a 50% loss. But it might show that right into close. It's going to lock that price at close, and it's going to show a 50% loss over maybe the entire weekend. And then on Monday, volume will move back in, that bid ask will shrink back together, and the price will be more normal. But all the while over the weekend, you're panicking thinking you've had a 50% loss. If that happens, if you see a wild change in your options price all of a sudden, it might be because of a weird expansion of the bid-ask spread. In that case, come look at volume, look at open interest. If those two are still high, if there's anybody out there still trading these things, don't panic. Generally speaking, volume will move back in and it will push that bid-ask back together, especially if it locks the price right into close. That happens a lot, where the bid-ask expands wildly right at close and it'll lock in a very strange price and you'll see a very ridiculous profit or loss. Well, don't panic or don't get too happy, because the next open, volume will move back in, pushing the bid-ask together, and it'll show a more reasonable price. Let me clean this up a little bit because I have one more thing to say. So I said you have to pay the asking price to get filled immediately, and you have to pay the bid price or sell at the bid price to get filled immediately when you're selling. So when you're buying, buy at the ask, sell at the bid. But does that mean you have to set your order, the price of your order, at one of those two prices? No. It doesn't. And generally speaking, I don't. Unless you're in a huge hurry, you probably shouldn't. The best way to handle this kind of situation is if you're wanting to buy this option, enter a price somewhere in the middle. It's called the mid price. You might see it on your brokerage actually. So in this case, I might enter an order for $1.10. This way, I'm trying not to pay the whole $1.20. And if I set an order for $1.10, someone that's on the asking side of things might meet me in the middle, and I could get a fill there. Same goes with when I'm selling. I could enter a sell order at $1.10, and someone from the bid side of things one of those bid buyers will move up to the middle and meet me there. If you don't get a fill when you set a limit buy order at 110, if you're buying, move it up a little bit, move it up a little bit, move it up a little bit until you're at either get a fill or until you hit the asking price. If you're selling this option and you don't get a fill in the middle, move it down a little bit, move it down a little bit, move it down. Like, keep replacing the order and see if you get a fill, and just keep doing that until you get a fill or until you hit the bid price, at which you definitely will get a fill. And just in case you're not familiar, a limit order is very easy to understand. So if this were a limit order, if I enter a limit buy order, what that means is I want to buy at $1.10 maximum, nothing more than that. So if I enter a limit buy order here, I could get a fill at $1.10. I could get a fill at a cheaper price, which would be great, but I won't get it filled at a higher price. When I'm selling, if I enter a sell limit order, it means I want to sell for $1.10 or more, but never less. So I could sell for $1.10, might be more than that, but never ever will it be less than $1.10. That's the bid-ask spread and volume and open interest. You want to look at this every single time when you're getting into an options trade. What is the options bid-ask? How wide is it? That's going to be representative of high volume and high open interest. So you're going to get more fair prices. You're going to give up less money by getting in and out of the trade, and you won't get stuck in a situation where you're having a hard time selling the option, which is not a very great situation to be in. It's pretty rare. Generally speaking, you can always sell or buy an option, but the less liquidity, the more ridiculous you have to pay when you're buying, or the more of a ridiculous price you have to pay, sell for. So liquidity is very important to look at, and to do that, you look at the bid-ask spread, which is going to be really driven by volume and open interest. The width of the bid-ask is driven by volume and open interest. Okay, so some questions to make sure you're tracking what the bid-ask is and why it's important, as well as volume and open interest. Well, first, what is the bid price and what is the ask price? Define volume and define open interest as well. Why is the difference between the bid and the ask, aka the bid-ask spread, important when it comes to trading options? And what is the relationship between volume and open interest and the bid-ask spread? And really the main important question is, what is liquidity? What is options liquidity? And why is it important when it comes to trading? Why is it the first thing you look at when you go to look at an option to purchase? We are approaching the finish line quite quickly. All that we have left is explaining the difference between puts and calls, which is actually surprisingly easy. And then after that, I'm going to go through step by step through my thought process as I enter an actual trade. So it's going to be a real trade on WeBull. You'll see me enter it and everything. The difference between puts and calls is actually, there's not much. Calls, you're betting on the stock going up, right? Your delta is positive. Puts, you're betting on the stock going down. Your delta is negative. Now, the reason why you make money as the put goes down is based on how exercising differs for puts than it does with calls. So here's what I mean. Before we were looking at calls, right? Before we were looking at calls on this left side. We don't care about these right now, okay? We're looking at puts. Put options are very similar, okay? These puts share the strike prices with the calls. So there's a 92.5 call on the left side, 92.5 put on the right side, okay? So All these strikes apply both to these calls and these puts. Let's talk about what exercising means for a put, because it's different than with a call. With a call, when you exercise, you buy 100 shares at the strike price. With a put, you sell 100 shares at the strike price. At K. Remember, K is strike price. And if you don't own those shares, you're selling short. Selling short means you automatically borrow some shares from your brokerage and sell it for some money. You hope that the stock price goes down so that you can pay less to get those shares back and return them to your broker. So when you exercise a put, you buy 100, or excuse me, you sell 100 shares at the strike price. So that changes things. That changes how intrinsic value is built, and it changes what options are in the money and out of the money. To illustrate this, let's go through an example here. This 98 strike put, okay, we're going to look at this guy. If this were a call, it would be out of the money, correct? The strike price is higher than the share price. But in this case, it's actually in the money for puts, and we'll just explain why. Let's run through an example. Let's say we have this put option in our possession and we exercise it. So we sell 100 shares at the price of $98 per share. And then what could we do? We could go buy to close this position at the current trading price. When we sell these shares, we're selling short. We have a short position. To close it, we have to go buy 100 shares so we can return them to our broker. And we can buy those 100 shares at the current stock price of $96.84. So we buy 100 at $96.84. So we're paying, use your brain, Adam, $1.16 less. We're paying $1.16 less to close our position. So we receive $9,800, but we pay back $9,684. We get $1.16 of value out of this per share of the 100 shares. So in essence, we would extract $116 of value. The exact same way as if you exercised an in-the-money call option. The value that you extract is identical. It's just that where calls would be out of the money, puts are actually in the money. And where calls would be in the money, puts are out of the money. So puts gain intrinsic value as they become more in the money. And that's the same as with calls, except for they gain intrinsic value as the stock price drops. But the amount of intrinsic they get per dollar the stock decreases is the same as with calls. It's $1 in premium that they gain as intrinsic value. So intrinsic value and extrinsic value work the same for both puts and calls. It's just that calls gain intrinsic value as the stock rises, while puts lose intrinsic value as the stock rises. Calls lose intrinsic value as the stock drops, puts gain intrinsic value as the stock drops. All because exercising is different, where with puts, you sell 100 shares, with calls, you buy 100 shares. So they're different, so they're flipped. And this changes a few things when you're actually trading them as well. Let's take a look at the Greeks really quick. So we have delta, vega, theta, gamma. We don't give a flying F word about rho. I really don't care. So we're looking at calls and puts in the Greeks. With calls, delta's positive. You make money as the stock goes up. You lose money as the stock goes down. There's a positive correlation. With puts, it's the exact opposite. It's negative. As the stock rises, you lose money through delta. As the stock goes down, you gain money through delta. There's an inverse correlation. Vega, positive for calls. That means that you make money as implied volatility increases. Implied volatility is good for all options because all options are defined risk strategy. The more anticipated volatility, the better, because if things go against you, your losses are capped. If things go in your favor, there's basically uncapped potential profits. So Vega is good for both calls and puts. So positive for both. Positive correlation between implied volatility and call premium and put premium. Theta, negative for calls and negative for puts. Both lose value as time passes. Both have extrinsic value, which is given to the options premium based on implied volatility and days till expiration working together, and that decays off both call premium and premium as time passes. Therefore, theta is negative. Gamma is positive because gamma just represents how much delta changes by a $1 move in the underlying. So the only Greeks that's different is going to be delta, rho as well, but we don't care about rho. It's going to be delta. You make money as the stock price goes down with put options, but you still have to deal with time decay, and you still want to buy options, put options in low implied volatility environments to capitalize on that mean reverting characteristic of implied volatility, because implied volatility is good for both puts and calls. Okay, a couple more things to note as differences. Let's write out break even down here. Break even is different. Because we want the stock price to drop, and for every dollar the stock price drops, we gain $1 of intrinsic value, we want the stock price to decrease in order for us to reach our break even. By expiration, we must have a thick concrete layer of intrinsic value that is equal to however much we paid for the option. Because at expiration, all our extrinsic value is decayed off. So we have to have that cement block of intrinsic value in order for us to break even at a certain stock price by expiration. So if our option, for a call option, if our option's worth $2, our option, our strike price has to be $2 in the money by expiration in order for us to break even, which means that break even for calls is strike plus premium paid, call premium. So if my strike is 96, then I want the stock price to be strike plus call premium of $2, 98. When the stock price is 98 at expiration, we'll have $2 of intrinsic value. So our option will be worth the exact same as it was when we first bought it. So we'll be at break even. This is different with puts in the sense that we don't want it to be plus, we want it to be minus put premium. So if our put option is worth $2, well, and our strike is 96, what do we want the stock price to be by expiration to break even? We want it to be 96 minus 2, which equals 94. So we want the stock price to be at 94, because if we're not 94, that means our option is $2 in the money, 2 points in the money. If we exercise this option, we can sell 100 shares at 96 and then buy for the cheaper price of 94, collecting $2 per share of those 100 shares. So at 94, we will have $2 of intrinsic value after extrinsic value has completely decayed off, which will be equal to the initial price of that option. So let me write it where I initially wanted to write this. Break even for put options for puts equals strike minus put premium. Break even for calls, just to give you a comparison, is strike plus call premium. So it's flipped. Because intrinsic value for puts grows as the stock price decreases, then you want the stock price to go down in order to build up intrinsic value. Therefore, your break even is going to be below your strike. The opposite is true for calls. And lastly, I just kind of want to draw it out for you so you can visually see the difference between puts and calls. So here we'll do call premium. Okay, this is going to actually we'll do profit loss. This is a profit loss diagram that we discussed before. Here's the call option. Okay, our strike is right here. When the stock price, S sub 0 on the x-axis, is below our strike, we'll be at a max loss. And let's say we'll say call premium equals $1. We'll say put premium over here is $1 as well. If the stock price is below strike at expiration after extrinsic value is decayed off, or if you exercise where you give up extrinsic value, you'll be at your max loss of minus $100. For a little bit past your strike, you'll be recouping some losses. And then right here will be your break even, which is strike plus call premium. After that, you're making profits that are potentially uncapped, but really, are they uncapped? No, because within the lifespan of your option, the stock is going to go to a certain price. Okay, it's not going to go to infinity. So even though theoretically the stock price could go up to any number, really it is capped. It will end up at some number at some point. Okay, there's only a certain amount of reasonable stock prices the stock could go to, unless you're looking at Tesla. So really it is capped, although we theoretically think about it as uncapped. Now let's look at a put option. How is that different? All right, here is our put profit loss at expiration, or if we exercise. Right here is going to be our strike. And above our strike is when our put option is going to be out of the money if the stock price is above our strike. And at that point, we'll hit our max loss of minus $100. For a little bit below our strike, we'll be recouping some of those losses. And then we'll have our break even, which is going to be K minus C. I'll just write that again right here. Past our break even by expiration, we will have a profit, and our profit is capped because the stock price can only go to 0. So we can't build up more intrinsic value than is available if the stock price went to 0. It can't go negative. But the odds of it going to 0 are pretty slim, and if you held a put option to 0, you'd be pretty lucky. Although by the time it hit 0, I think it would be delisted and nobody would be trading options anyway. So you might actually be screwed. But so it is capped, but is it really capped? Is it capped in the sense that it's said here, like if the stock price goes to 0? No, you're not going to buy a put option and the stock price is going to go to 0. It's capped in the same way that calls are capped, which is the stock price is only reasonably going to drop so far. It's going to stop at some point. If you're buying calls, well, if things go your way, the stock price is only going to go up so far. It's going to stop at some point. So in my opinion, I like to think as both of these are capped, and not because the stock price will go to 0 like with puts. I'm just saying that the stock price will only go up so far or down so far within the lifespan of the option. So I don't think of calls as better because they're uncapped. because statistically they are kind of capped, and same with put options as well. Everything else we discussed between puts and calls work the same between the two. Okay, they're very similar. You can almost just think of put options as calls in reverse. Just flip the in the money and out of the money, and that's basically it. They act the same way as calls do. They build intrinsic value as they get more in the money. They have extrinsic value based on implied volatility and time, which decays off as time passes by the rate of theta. Theta will exponentially increase for both puts and calls within 30 to 45 days out. At expiration, if your put's in the money, you better exercise it to prevent it from expiring worthless. If it's out of the money, all of its extrinsic value is decayed off, and it will decay. It'll expire worthless, and all the money you put into the option will be gone. The bid-ask spread between calls and put options work the exact same. You want to look at them, and a tight bid-ask spread is very important for both puts and call options. The way you sell and buy is exactly the same. The way you choose expiration dates is exactly the same. The further out expiration you have, the more expensive the option is going to be, but also you have more time in order to reach break-even, because no matter what expiration date you choose, your break-even will always be K plus C or K minus P. I'm sorry, I wrote K minus C here. I meant put premium. I'm a donkey. So yeah, if the further out you buy an option, the more expensive it's going to be, the more money you're risking because it has more extrinsic value because there's more time until expiration. But the benefit of buying an option further out, and I often buy options very, very far out, is that you have more time to reach your break even. If you have a very, very high break even, which means you bought an out of the money option, whether it's a put or a call, and you have a very, very short expiration, which expires maybe in a week, you'll have a lot of leverage. That delta will be a massive percentage of the value of that option. But you're going to have a really, really high break even or a really, really low break even for puts. In other words, the stock price will have to go very, very far for you to break even, and you'll have a very small amount of time to do that. So if you look at Wall Street bets, that's all they do. They buy what's called weeklies. They buy options that expire maybe in a week, and they choose out of the money options, okay? That way, delta is a very large percentage of the overall value of the option, and then they buy a bunch of them. So they have a ton of leverage, but they evaporate quickly, and there's not enough time for them to reach break even. The stock price isn't going to move that quickly, so they expire worthless and they lose all their money. That applies to both puts and calls, and it's important to choose expiration dates that are pretty far out, especially when you're buying puts and calls, if you can afford it, if you can keep a good diverse portfolio, because then you're going to have more time to reach your break even, and theta will be a smaller percentage of the overall value of your option. Although, yes, you are going to be spending more money, which means if things go really, really wrong, you will lose more money when you buy a more expensive option as a later expiration date. I also want to say that buying in the money lowers your break even as well. So if you buy in the money with a far out expiration, well, buying in the money makes it more expensive. Buying farther out makes it more expensive. When you buy in the money, it's more expensive because it has more intrinsic value. When you buy a further out expiration, it's going to make it more expensive because it's going to have more extrinsic value. If you do both of those things, yes, the option is going to be more expensive. Yes, technically you're risking more, but your probability of success is going to be much higher because you have more time to be correct. You have more time to reach your break even, and your break even is going to be lower. And these are all things we're going to take a look at when we actually trade options. But I'm just giving you some more tidbits into my thought process when I'm looking at options, why you choose a further out expiration, why with put options and call options, generally speaking, your probability of success is going to be higher when it's in the money and a further out expiration because it lowers your break even and you have more time to reach that break even. And I also just want to warn you that a lot of people do trade out of the money options with short expirations and use them as lottery tickets. But in general, the majority of people, and it's a fact that statistically, the majority of people will not be successful trading out of the money options frequently. I'm not telling you what to do. I'm just saying I've seen it all over the place where people think they'll get lucky and they don't, and they burn their money. And I've done it myself a few times. Okay, so with that said, I'm going to ask you some questions just about the differences between the two, and then we'll move on to some real live trades. You ready? For calls versus puts, I want you to think about what the differences are kind of to yourself. How does exercising differ between calls and puts? How does break even differ between calls and puts? What about with the Greeks? What are the different Greeks between calls and put options? Is implied volatility still good for put options or no? You make money with calls when the stock goes up. How about with puts? And if you can answer why that is, that's even better. So I just want you to run through those things and think about how they're different, and then check down in the description below to make sure that you got everything, you're not missing anything. Once you've reviewed that, let's head on to the next section. Congratulations, you have slogged through a lot of dense material, and we're actually getting to the fun bit here. So we're actually going to do a real trade. I have some money queued up in WeBull, so we're going to actually do it. But before we do, I just want to analyze two types of trades. I want to analyze buying out of the money call options on Microsoft, and I want to analyze buying an in the money call option on Microsoft and take a look at the difference between the two, so you know exactly why you choose certain strikes and why you choose certain expiration dates. While your thought process when trading options may differ from mine as you gain your own experience, the basic process that we're going to go through today is probably something that you should be doing every time you buy an option, or at least your decision-making process should be a good reflection of what I'm doing here, because everything that we're going to go through to buy this call option is pretty fundamental to making sure you don't screw yourself over. So that said, let's go to optionsprofitcalculator.com and take a look at two potential strategies that we could implement. So we're going to do a long call on Microsoft. Long call means you're bullish. If you did short call, that means you sold to open an option. But we're doing a long call. We haven't talked about selling to open in this tutorial. And we are going to type the symbol of Microsoft, MSFT. And we're going to buy an option. We select the option. We're going to do some out of the money options first and see what our profit and loss could be in that scenario. So we're going to choose an expiration that's about 1 month out. So short expiration, very far out of the money. So we'll do the 242.50 strike call option. It's very far out of the money. So you can see the bid price on the left and the ask price on the right. We're going to choose the mid price because, like I said, yeah, if we wanted to get filled immediately, we'd buy at the ask. Generally speaking, though, I enter a limit buy order in the middle of the bid ask, which is aptly named the mid price. So we're going to select that, and we're going to buy a bunch of these. We're going to buy 30 of them. We're going to hit calculate. You can see the total cost is $3,960. Okay. Now, open a new tab if you're following along, or if you're just watching, that's fine. And we're going to do a long call on Microsoft, and we're going to do an in the money option. So select option. We're going to choose a very far out expiration, about 9 months from now. And we're going to choose an option that's about the same value as these out of the money options, all 30 of them. So these are worth $3,960. So we want the call option that's about the same. So we'll choose this 195 strike. That's $3,985 worth. And it's just one of them, so we'll hit calculate. Okay, let's pop back over to these out of the money options. Look at that. Do you see how your break even rises super fast? That's because theta is a large percentage of out of the money options. And when you buy a bunch of out of the money options, that means you're going to have a super, super huge theta. So the value of your options is decaying quite quickly. And because also out of the money options have a high break even due to this, which correlates with the high rate of decay of the premium, you better hope the stock price moves quickly and gets above your break even of, in this example, 243.81 before expiration, or your money's just gonna start evaporating very, very fast because these out of the money options are completely consisted of extrinsic value. And as you know, extrinsic value decays off as time passes, and in this case, the theta, the rate at which they decay is very high because they're out of the money and because they are within 30 to 45 days until expiration, at which point theta ramps up exponentially. So you can see that theta degrades the value of these options very, very fast. But let's say we get lucky. Let's say that Microsoft pops up to $234 today, the day we buy it. How much do we make? $7,140. Now, this doesn't account for changes in implied volatility, which will affect your profit and loss somewhat, but it is a good estimate of what our profit would be. So $7,000. Well, how about with our in the money option, which is worth the exact same amount, or pretty much the exact same amount as our out of the money option. So let's say if it pops up to $234 today, we make $763. We make a fraction of what we make with out of the money options. Okay, well, out of the money options sound pretty good so far. What happens if it stays at $234 for a month? Well, if we follow that over, it goes to zero. We lose everything we put into the trade. Not only do we lose all those profits, that $7,000, we also lose that $4,000 we paid for these options because they're out of the money, they'll expire worthless. How about with our in the money option? If it pops up to $234, it trades sideways for 9 months, we lose $85 as compared to losing $4,000 if it trades sideways for a month. $4,000 plus our profits is what we lose. So you can see that, yes, if things go quickly, out of the money options are your friend. But how often do things go quickly, or at least how often do you guess the right stock when things go quickly? Not very often. And what people at Wall Street Bets do, while it may be funny sometimes, is they will buy a bunch of out of the money options, and they'll have these positions that have a large amount of theta, but they also have a huge delta. Because delta is also a large percentage of the value of out of the money options, if you buy a bunch of them, you'll have a super huge delta. In fact, the delta of this out of the money position is larger than the delta of this in the money position because there's so many out of the money call options in that position. If we look at one out of the money call option and one in the money call option, we know based on everything we've discussed, this out of the money call option has a smaller delta because as you get closer or deeper in the money, the larger your delta becomes, approaching 1. But because delta is a larger percentage of the value of out-of-the-money options, if you buy a bunch of them, you can have, that's the same value as one in the money option. It will have a higher delta than this one in the money option. So you have more leverage, but theta is also super, super high. So you also have more time decay. What was I saying? Oh yeah, so the Wall Street bets guys, they'll look at this and go, I have no self-control. I'm also a stock picking genius. So they'll buy a bunch of out-of-the-money options on some meme stock and watch their money light on fire and decay to nothing. And then they'll do it again and 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 again. And they're constantly buying and selling, panicking, doing all sorts of stuff. And then at the end, they take a step back and they see they're down 99% over the last 4 months. That's what idiots do. That's what gamblers do. That's what Wall Street Bets does. No offense, because I know some of you guys are out there. You know, you guys are my OG homies, but you're also kind of dumb, and I appreciate that. At least you know that. Instead, what you could do is, yes, give up some of the leverage, but increase the probability of success by having a lower theta and a lower break-even and more time to reach that break-even by buying an in-the-money option with a far-out expiration. Now, this might be too expensive for your portfolio. It'll be cheaper with cheaper underlyings or lower implied volatility, but if this is too expensive for your portfolio and you're like, I can't do this, well, you can give up some time of expiration, but you also have to realize that you're going to have less time to reach your break even. That'll make options cheaper. You could increase the strike, but that's also going to increase your break even. So you're giving up some probability of success to have a cheaper option. Instead, what you could do is trade debit spreads or credit spreads. I encourage that you learn about those if you want to reduce the buying power necessary to enter an options trade. I also encourage everybody to learn about cash secured puts or covered calls. But me personally, I generally stay away from this option strategy because, yes, once in a blue moon, someone gets really, really lucky, makes a ton of money. But more likely, you're going to lose your money. And if you don't lose your money and you win, generally speaking, I've seen people just get overconfident and they repeat the strategy. And the strategy is a losing strategy over time. It has a negative expected value. So they'll repeat the strategy and then lose the gains that they made. Okay. No. Anytime I see someone say I made 10 grand, first of all, I want to see their all-time chart. Second of all, I want to see them how they're doing in 6 months, because generally speaking, they'll lose it all if it's 10 grand on a $500 account. Okay, so this is my preferred strategy. So this is what we're going to roll with today. We have a nice low break even. It's even lower than our out of the money position over here, even though we have 9 months to reach it. That's great. So we had a higher break even and 1 month to reach it with our out of the money position, but now we have a lower break even and 9 months to reach it. So how do I determine where I think the stock is going to go? Well, generally speaking, when I buy call options, I don't really have a price target, which is probably kind of weird to hear. I don't have a price target. I don't care. There's one thing I care about, and that's that the stock gets above my break even. That is it. And what is my break even? It's 234.85, which is about 4% above the current stock price. Do I think that Microsoft is going to be above 234.85? That's going to go up 4% over the next 9 months. Yeah, I think Microsoft is going to go up 4% over the next 9 months. And if I'm wrong, I'm willing to pay the price. Do I know exactly where it's going to go? No, what's the point? What's the point of choosing an upside? To pick the favorable risk-reward ratio that makes you feel good? There's no point. Do I think it's going to be above my break-even? Yes. And that is what I meant when I said, use your break-even as your target. That's what I mean. You want it to be above your break-even. If you have a really, really high break-even, like with these out-of-the-money options, where you're like, yeah, but I think the stock price is going to be up here by December 30th. I don't really care about expiration. What if things go wrong? Okay, you have to use your break-even as your target because it's your worst case scenario. It's the lowest value your option will be, which is at expiration after extrinsic value has decayed off. So you have to pick worst case scenario, and that is going to be where your break-even is. So I look at my worst case scenario, 4% to the upside. Yeah, I think that Microsoft will rise by 4%. It could do so in the next 3 days, not let alone the next 9 months. So this is why I buy these options. Anyway, I say all this to say, the longer you give yourself and the deeper in the money you give yourself, the higher probability of success, although technically the more you're risking because the more expensive the option is going to be. As far as stop loss goes, where you're going to sell, that is up to you to decide where you're comfortable selling, where where you'd be uncomfortable holding, I guess is a better way to put that. For me, though, generally speaking, nowadays, I buy call options that are very deep in the money, very far out expiration, year or more, and I don't ever think about selling them. That's just me, though. All right, so now that we've gone through the differences of expiration, strike, and out of the money versus in the money, let's actually buy this call option so you can see what it looks like. All right, so let's buy this call option on Microsoft. So when you have WeBull open on your phone and you have the account you want to trade in selected, you want to tap on Quick Trade in the middle of your screen towards the left. the blue hammer there, and then Microsoft. And bottom right, select options. Okay, by default, you're only going to see 10 strikes. Okay, we want to change that. So, well, first let's collapse this options chain by tapping on the expiration date, the 24th of December 2020. And then we'll open up 17th September 2021, which is the expiration we want. Then to see more strikes, because we can't see our 195 strike call here, we want to tap on the 10 in the bottom right. You see that? The 1-0 in the bottom right. Tap on it. We'll change it to 50 for now. And then we will find the 195 strike call, which is worth the mid price, or the last traded price was $4,000. Let's tap on that. And we want to see more statistics because we want to see the liquidity of this option, right? We want to make sure that, yeah, I mean, looking at the options profit calculator, everything looks good, but it's only good if we can buy and sell it for a reasonable price. So let's tap on the 195 in the bottom left. You see 195, 17 September 21 call. Tap on that guy. Now we can see some option statistics. First thing we're going to look at, would be volume and open interest. Volume is 5, open interest is 469. Is that super high? Not necessarily, but it's good enough for me because volume, any volume on an option that expires 9 months from now is a good thing. If someone's trading that option today and it expires in 9 months, that means there's some interest in that option. And the open interest is decently high. Okay, it'll increase both volume and open interest as the expiration nears. So for an option that's far out in expiration, this liquidity is decent. And to confirm that, we want to take a look at the bid-ask spread. The bid-ask spread is 39.15 to 39.55, which is 40 cents wide. 40 cents is about 1% of the overall value of this option, which is a small amount. 40 cents is 1% of $40. And then we can see on the bid side, we have 5 bid orders stacked up. And on the ask side, we have 130 ask orders stacked up. And you will see that that will change, just as time passes. So this is looking good to me. Okay, there's plenty of orders on both sides. There's some open interest, some volume, and the bid ask spread is relatively tight, which means there's market makers that are participating. There's traders that are participating that are engaging in price competition that's pushing the bid ask closer together. So this is looking decent to me. So we're gonna go ahead and buy it, but let's make sure that before we buy it that we have Oprah real-time quotes. Remember in the top where that blue, I guess in my case it's a lightning strike, is for you it might be a blue clock. If it's a blue clock, that's no good. That means your data is 15 minutes delayed and you have to sign up for Oprah real-time quotes. You get a quote. You get a quote. So once you do that, then you'll see accurate information. We definitely want to see accurate information before we enter any orders here. So let's buy this option. So we tap on it, okay? We're gonna hit edit in the bottom left. We can change the strike if we want, but we selected this strike with intention. And let's take a look. We have a limit buy order. Underneath the limit order type, we can see limit price, and underneath that, we can see the bid-ask spread. The bid-ask spread is 3895 to 3935, and it's constantly changing. The mid price is 39.15. So what we're going to do is we're going to enter a price at the middle and see if we get a fill. So let's do that. Let's change the limit order through 39.15. Word of caution, you can change this from limit order to market order. Market order will get you filled at the best available price, but you have to be careful because options prices change pretty significantly. It's not like with shares where buying market's totally fine because shares generally have a bid-ask spread of 1 penny. If the bid-ask changes wildly or someone places a really extreme order and no one else is trading even just for 1 second and you hit market order, you could get a ridiculously expensive fill. So you want to always do limit orders with options. Don't do market orders, okay? It's just not worth the risk. So instead of limit order at the mid price, we're going to change it to the mid price, which is 39.32. This has to be in the 5-cent increment. So we'll do 39.35. So it's leaning towards the ask price. So it's more likely to get a fill. And then we'll hit buy. Here we can see the symbol, Microsoft. You always want to go through, make sure everything's looking good. Otherwise, you can make a mistake. There's plenty of times where I've bought calls when I wanted puts and puts when I wanted calls. Okay, it happens to everybody. So go through everything. Microsoft 195 strike call expires on 17th September 2021. Correct. We're buying it. Yes. Contract 1. We only want one of them. Yes. Order type is a limit buy order. Great. Limit price is in the middle price. Good. And time in force is day, which means that if we don't get a fill by close today, it'll cancel. If we set that for a good till canceled on the previous page, that means it'll stay pending for 90 days. And if it doesn't get a fill, it'll cancel. Great. And we can see our break-even last price, our max loss, and our unlimited max profit, which is not unlimited. It's just capped by wherever the stock is going to go before expiration, which is limited. It can't go up to infinity. Hit confirm. Now we have an open order, and let's see what's $39.35 is what we're trying to buy it for. The middle price has jumped up a little bit. So to save us time, generally I would just wait and see if I get a fill over the next 10-15 minutes. But to save us time, let's move the price up a little bit. So if I tap on open orders at the bottom, then tap on the Microsoft call, we can cancel and replace this order. So we'll hit modify, and we'll set it for $39.50, which is now around the new mid price, because the price is fluctuating, it's moving up. So we'll hit buy, confirm. Oh, it got filled. That's why. Okay. So it actually got filled before I could modify it. Great. So we can see our position now. If we go back a bunch, back. Here in our portfolio, you can see the Microsoft call, and we've made $5 already. Easy money. And it'll always show the last or average price and not the bid or the asking price. Okay, so this is where I'd hang on to it. It would sit there and it would accrue some profit or accrue some loss, and increase in value or decrease in value. The factors of the Greeks of Vega and Theta and Delta are going to all affect the value of this option. And that's something that you have to consider too, is that if the stock price rises and your option loses money or does not also rise, there's a few reasons for this to happen. One is Theta. If Theta is outdoing Delta, then you're losing money or you're not making any money. Another cause for this might be if implied volatility is decreasing, so you're experiencing a little bit of IV crush. It's counteracting the positive effects of Delta as the stock price rises on your option. So if implied volatility is going down, even though the stock price is going up, it is possible that you don't make money or that you lose money. Another reason might be that the option is not very liquid, and so the prices are kind of irregular and jumping around a lot. That might be another reason. So don't be surprised if your option doesn't increase in value immediately when the underlying increases in value. Okay, so we made $5 on this. Let's just take our money and run, right? How do we close out of this position? Well, we'll tap on it, and in the bottom left, we can sell. Now look at that. In the bottom left, it also says, do not exercise at expiration. If you don't want this option to exercise, tap on that, hit OK. It won't exercise at expiration, but that means that if you hold it into expiration and it's in the money, well, it'll just expire worthless, which is stupid. You should sell it before expiration. If it goes into expiration, you absolutely should exercise it if you could afford to. Otherwise, you're going to lose all the money you put into it. So personally, I'd leave that unchecked. But generally speaking, I would probably intend on selling this option before expiration anyway. But just if I have the funds available to exercise or the margin available to exercise, I will do so to prevent it from expiring worthless. Even if you just use the margin for a day and then you sell all the shares at the current market value, that'll prevent your option from expiring worthless. Okay, so something to consider. Now, if we want to close this position, we could hit sell. Okay, that would sell this exact type of option. But if you want to make sure that we don't accidentally sell an option we don't own, tap on close. Selling an option you don't own is writing a totally new contract. Here we'd set a limit order, okay, and we'll set it somewhere near the middle price of $39.40 to exit out of this position. And when we look over that and that looks good, we'll hit sell, look over this really quick, and confirm. And you can see that I went into open orders and then got filled. So if I go back to my home screen, you can see our position is gone. Now, if we want to see how much money we've made, we can see our history of our trades by going to more. In the top, you see orders. And we can see that we bought and then sold a Microsoft 195 call. So let's tap on the buy. We bought it for $39.35. And then we sold it for $39.40. So we made $5. In the time we're talking. Thank you for letting me do this example for you to make a smooth $5. So that's how you buy and sell options, and you have to consider all the things we talked about, especially when it comes to expiration and strike. All the fundamentals that we discussed tie into how the options premium changes as time passes and relative to where the strike is and relative to where the stock price is. It's a lot of information that once you take a step back and you have it all in your noggin, it actually is pretty simple and it's pretty glassed over and pretty intuitive when you actually start trading them. But you have to understand everything so that you don't miss anything, you don't make any stupid mistakes that cost you money, and you can go out there and trade these effectively and really know what you're doing and why you're choosing certain numbers, choosing certain expirations, choosing certain strikes, why you're making money, why you're losing money, and it'll give you more ammo when it comes to learning more complicated strategies as well. Now, at this point, I just want to say thank you. If you made it to this end of the video, I know it was really long, and it is absolutely astounding that you're willing to sit through all of this to learn this kind of information, but I think it'll prove useful as your investment career goes forward. And if you haven't noticed, I started this video a few days ago, maybe 4 days ago, and I haven't shaved since. So this is my stubble, and I apologize. It looks like pubes taped to my face, but maybe don't put that in there. Jesus Christ. And it's been an absolute pleasure, and I've had an absolute blast doing this. Okay, brain dumping all the information that I've learned over the past 4 or 5 years is super rewarding to me, and I appreciate you watching this video. If you have any questions, you can ask them in the comment section. If you want me to answer your question in video form, it'll cost you a little bit of money, but you can click on the link to Hey Hero down below. There's also free stocks down there. You can check out Fantasy Invest. It's an app that will allow you to potentially earn prizes by paper trading stocks with other people. Thank you so much for coming along in this journey. I wish the best of luck to you, and I hope to see you around in the comment section and maybe elsewhere. You take care. Bye-bye. And remember, buy the dip.
I'm dying.